Good afternoon, everyone, and you're all very welcome to Glenveagh's Investor Day 2020. Delighted to have such a strong, well-educated audience. Thank you very much for coming. Glenveagh, to remind you, was established just over 28 months ago with the clear goal of becoming the leading sustainable home builder in Ireland, and we think we're well on our way to achieving that. We've built a talented and vigorous team. We have now got a clear organisational structure, and that's going to take your company to the next stage of expansion. We have ambitious but, I believe, achievable goals and targets, and they're clearly set out in this morning's RNS. Today, the presenting team are joined by several board members, we're glad to see here, and members of our senior team. And during the course of the afternoon, we're delighted to chat with you, take any questions that you might have. As you know, strong corporate governance has been a pillar of the group from the outset, and we've put in structures to make sure we can do that while the business grows, but in a sustainable way, while not losing our entrepreneurial spirit and energy, and that's the balance. In that regard, we have continued to strengthen the board of Glenveagh with two additions during the year of Pat McCann and Cara Ryan, and their contribution already has been not alone notable but noticeable. Pat is Chief Executive of Dalata, which is our leading hospitality and hotel group in Ireland, and he shares with us a passion for the consumer, and he also has had to endure the trials and tribulations of large-scale development, and building hotels are not that different from building apartment blocks. Cara Ryan has a background in economics and finance and has wide experience in both fund management and on the financial side of residential development. So, in our market, there continues to be a long-term demand for at least 35,000 units per annum, and we intend to be the volume operator supplying that opportunity. So, the agenda today, we hope we will leave you with a comprehensive understanding of where we are and where we intend to go and how we intend to get there. We'll bring you through the group's strategy, and we'll update you on the market environment that we're operating in, our land investment and holdings. We will, of course, break for coffee to give you a break. And on return, we'll brief you on the operational and financial parts of the business, and we'll show you what makes Glenveagh different. At the end of Stephen's delivery on our strategy, we'll have a Q&A session with him. And we'll also have a Q&A session with the whole management panel at the end. Just to remind you, everything seems these days has to come with some sort of health warning somewhere along the line. We're in a closed period with our full year results at the end of February, so I know you'll respect that and try and get around it with your questions as best you can, but we'll be resolute. The speakers, we're rightly proud to have a terrific team in Glenveagh, and some of them will shortly be presenting to you. We've also, as I mentioned earlier, we'll be joined by a number of other members of the senior team, and they'll be happy to talk to you informally during the course of the afternoon. But let me briefly introduce our team that will be speaking to you. Firstly, we have Michael Rice, our CFO, and he's brought the rigours of his PLC experience to bear on Glenveagh. He's impressed us all with his leadership, not just in the financial aspects of his role, but also in putting in place the structures and processes that are essential as we execute our expansion. However, we do also intend to concentrate today on our strong delivery capability, and we have three key members of our delivery team here today: Tony McLaughlin, Fergus Boyle and Peter Gavigan. Tony has overall responsibility for the group's unit delivery, and in the past year he has excelled in that, as you can see from our numbers, and that has been in a fairly challenging environment. We also recognise and have recognised the need for specialist skills to deliver complex urban schemes, and we selected Fergus Boyle to join the team from Ballymoughal in London, where he has an exceptional track record of large-scale apartment delivery, and he'll be driving Glenveagh's construction approach to that segment. Peter Gavigan is bringing his private and public sector experience in planning, design, and the manufacturing side of our business, which is crucial to scaling the business the way we want to do it in a sustainable manner. We have Wesley Rothwell, who has executed the sourcing plan that's given us a highly attractive starter home land portfolio, and he'll brief you further on progress there. Conor Murter, who most of you know, keeps us all on our toes, works tirelessly to keep our shareholders completely up to speed on where we are and how we're measuring up. Finally, and importantly, we have our CEO, who has transformed, Stephen Garvey, who has transformed the way home building is conducted in Ireland. It's fair to say he is a terrific example of a leader who not alone walks the walk in terms of building, but he has a profound and progressive knowledge of our industry. And I don't think it's overstating to say that while there was home building in Ireland before Glenveagh, we are making the landscape completely different. I should just mention to you that that team, the bios for them all are in the back of your pack. So, without further ado, I will introduce you to Stephen, who will bring you through our strategy. Thank you.
Thank you, John. Good afternoon, ladies and gentlemen, and you're very welcome. If you could indulge me for a moment, I'd like to take you back 10 years, almost to the day when the wheels were set in motion for where we are now. If you could imagine the scene, it was a cold and frosty night as I sat with my thoughts, waiting for concrete to cure. Those unfamiliar with the process, it is quite a laborious task waiting for concrete to set in order to power float. And at the time, as I led a construction business in the midst of our worst recession, it was all hands on deck. So it was dark in every sense of the word that night. The ways of the past were not going to be the ways of the future, and the construction industry was in for profound change. What I could see on the ground at the time was the family-controlled, highly leveraged operations were going to be wiped out. No bank debt was available. We didn't even know if the banks were going to survive. And no one had any equity domestically. But there still was an underlying demand for quality homes. I knew then that the challenges we were facing were in fact our opportunities, and I started to envision where we needed to get to and what it would take to get there. We focused on the product, for affordable homes in locations where people wanted to buy them, the way you delivered that product, embracing a new methodology, and the manner in which that product could be delivered economically. To this end, we could see that the most conducive funding model to support and deliver this vision was long-term capital. Today, we are on the cusp of becoming Ireland's leading residential developer. Looking ahead to the next 10 years, we have a clear strategy of where we want this company to go, underpinned by a strong track record of experience in turning vision into reality. Today I'm going to take you through the first 5 years of this plan. Glenveagh, home of the new. Let me tell you what that means. Home of the new is not about just building new homes. It's about how we select and partner on our lands. It's about how we plan on those lands. It's about how we foster and embed relationships with the communities. It's about how we use technology to innovate how we deliver on these lands. It's about how we provide energy efficient, quality homes to the customer. Glenveagh sets itself apart by creating an experience that is different. What do I mean by that? We want to offer the customer the following: quality, energy leading homes in location of choice, in their home of choice, where they want to live and how they want to live. We want to streamline the process involved. We want to minimize the stress involved in buying your home, and we want to offer what others can't. Let me give you a sense of what the business has created to date. So that's what we are creating and delivering. Let me tell you how we are doing it. We have a clear vision to create the leading and most sustainable home building platform in Ireland. To do that, we have developed a culture that is safety-led, customer-centric, collaborative and innovative. I'm going to touch on each of these today, but you will see these characteristics come across as the rest of the team present. But the most important thing for me is the people. Almost 2,000 people work directly and indirectly for our business today. Our people that have a can-do attitude. It is this can-do attitude that has helped to ensure that the group has delivered on phase 1 of our IPO objectives. A key investor concern following the IPO: could you deploy the capital raised? Could you scale the business? We've not only succeeded in that deployment, we've assembled a land bank which is targeted at the deepest and most resilient segments of the market, starter homes in large urban centres. We have opened 20 sites in total, delivered 1,100 units, and have the same number under construction in a sustainable and profitable way that is core to our strategy: multiple sites in multiple locations. This strategy has delivered units, revenues and profits which have exceeded expectations in each of the years since IPO, all underpinned by a proven operations and construction philosophy. Excuse me. The market opportunity remains compelling. Population growth is driving a housing need, and the supply side does not exist to deliver what is required in the long term. Every well-educated economist in Ireland will tell you we require 30,000 plus units per year in Ireland, but we are delivering 21,500 units. Ireland has an accommodation crisis. We need first-time buyer product. 30% of our population is between the ages of 25 and 44, prime home buying years. Ireland needs a rental product. 6,000 mom and pop landlords are leaving the market every year, and are only being replaced by 3,000 via the institutions. Look at our inward migration numbers last year. 34,000 people came to Ireland. Look at the size of our tech industry in Dublin today. Almost 10% of Google's entire workforce are in Dublin today. We have a social housing need. 70,000 families are on the waiting list for a home. Smaller firms are going to fall to the side, and larger players will consolidate their positions. Exactly what happened in the UK. I'm going to bring you back to my concrete experience now, what I'm seeing on the ground. When I talk to the MDs of the concrete plants, they tell me demand is great, things are flying. But the people who really tell you the truth is the plant managers, the people who are sending the concrete out. And they tell me the following things. The smaller guy is struggling. The cost of capital is killing them. The regulation. They have no economies of scale. They can't control their costs. We have one of the most sustainable and conservative markets in the world. The newly appointed central bank governor from New Zealand said in his own words, house prices should be 26% higher today, only for the existence of the macroprudential rules. Glenveagh's capital and operational structure is our advantage in this market, and Conor is going to take you through that in more detail. Because of this opportunity, our focus remains on our core markets: suburban housing, urban apartments and partnerships. These three segments will replace the home and living banners. This will streamline communications to investors. So what are the characteristics of our end market? Suburban product is predominantly housing with some low-rise apartments. Demand is coming from private buyers, but institutions also. An example of this is the deal that we recently completed with IRES in Taylor Hill and Semper Woods last year. The majority of our portfolio is focused on the Greater Dublin area, but the product is required nationally, and we are best positioned to roll that out. Urban as apartments, to be delivered in partnership with institutions, primarily in Dublin and Cork, and locations with significant rail transportation hubs. These offer considerable attractions from a risk and return perspective, given the opportunities to forward sale or forward fund. Partnerships and mixed tenure is accretive to the business over the long term. We invested early, making us a partner of choice for key state agencies and local authorities. This is a long-term strategic decision that is coming to fruition, and we hope to be able to give you live examples of this through 2020. The attractions of our complementary business units are evident. Suburban, demand and alignment of buyer. That means affordable, high-quality homes in locations of choice. The majority of our product is 350 or below. Meets all of that. Fragmentation. The smaller guys falling to the side, as I mentioned earlier on. Easier optimization of construction process. Ability to deliver product quickly on multiple sites and multiple locations. Urban. Shift to rental, driven by millennials, lifestyle, and the size of our tech industry in Ireland today. This is being driven by a growing demand and an exodus of the mom and pop landlord due to regulation and fiscal policy, who are being replaced by institutional investors. This gives us long-term earnings visibility due to the early commitment of a forward sale or forward funds. What does a partnership look like? A partnership is a government or local authority putting their land on a reduced cost or phase basis into a development agreement with us. It has a reduced risk from a sales perspective, where 50% of the product delivered will go back to government or local authority via social housing or affordable housing, and 50% will have market exposure. That gives a strong return on capital employed, increased business resilience, reduced risk, fits with both suburban and urban segments, and gives us access to both land and deliveries. We have streamlined the business to deliver on this. So we haven't duplicated resources. Our central functions of underwriting, planning, design, procurement and corporate all support a delivery across all three segments. We split suburban delivery into teams clustered around distinctive geographies. This is on top of an already established dedicated team for site openings. Urban apartment delivery is a specialist skill set, and that skill set exists in our business, proven by the delivery of Greystones and Herbert Hill, both on time and in budget. Our first target in 2018 was 250 units. We delivered 275. In 2019 our target was 725. We delivered 844. When we commit, we deliver. We have committed to delivering 1,000 units in 2020, 1,400 units in 2021, and revised targets, as you can see, in 22, 23 and 24. We are now delivering 12,000 units by 2024. That gives us an annual run rate of 3,000 units. This gives you a breakdown of where the units are coming from, both in suburban and urban. Due to the size of the North Docks portfolio, we've singled that out, 110 million of capital, and our aim is to monetise over the time frame of the project, which commences this year. This will result in revenue, cash and profits in 2020 and 2021. Our internal resources will be delivering the docks. We will endeavour to apply a similar approach to a number of our urban projects, and we will be outlining this in more detail later in the year. The chart on the left displays how construction resources are presently allocated in the business. The chart on the right shows the ideal split of units across three segments once partnerships scales. This will optimise return on capital employed. I have consistently made the point at maturity and scale. We want to control approximately 4.5 to 5 year land supply in front of us. We are now committing at least 100 million reduction in investment by 2021 due to a ramp up and efficient use of capital. Additional reductions will be made when strategic or structured land deals happens. Partnership wins will allow us to further reduce this investment. If the business has the capacity to deliver 3,000 units per annum, this will require somewhere between 13,500 and 15,000 plots of land. To maximise return on capital, we envisage it being laid out in the following ways: 10,000 units potentially in our ownership, 2,500 in partnerships and 2,500 in structured pay-as-you-go deals. These are huge opportunities for Glenveagh because of who we are today. Not only have we the financial capabilities, we have the machine and we have the people. Quality is key to everything we do, be it our people, our supply chain, our health and safety, our policies. Key to scaling the business has been the people. Growing the business from 75 at IPO to over 330 directly today, with over 2,000 people working both directly and indirectly for the business. Health and safety is the first item on the board's agenda and drives an element of all staff's remuneration. We've already achieved various awards for our health and safety initiatives. Health and safety will always be to the forefront of the business. Consumers will always be to the fore of our business decisions. Given the international perspective of our board and the shortcomings identified in the UK, customer satisfaction has been a KPI for the entire business and drives an element of all staff's variable remuneration. We want our customers to experience the difference that is Glenveagh. We are externally audited to ensure we deliver for our customers on their experience. Full variable remuneration is not paid to employees unless the equivalent score of a 5-star status rating is achieved. Sustainable communities, exceeding our environmental obligations and sustainably integrating with our supply chain are all features of our operations. And the guys are going to talk you through this in more detail through their presentations. Let me give you a sense of what health and safety looks like in Glenveagh today.
In Glenveagh we're creating home safely. So the main objective every day is everybody comes into work and everybody goes home. Senior management involvement is the key cornerstone to everything. It provides good leadership for the organisation. We walk the talk is most importantly. Senior management, when they come to site, they set the standard. Everybody looks at them. So that's why we lead with safety. Training is ongoing all the time. We always address the competency levels of all staff. In-house we provide manual handling, abrasive wheels, working at height and fire training. External safe pass manual handling are provided by the company. When we identify an area of competency that we need to increase, we resource that area of competency and staff are provided with the appropriate training. Every morning we hold a whiteboard meeting. Planning is the key secret to safety in Glenveagh. At those 15-minute whiteboard meetings, that's what is planned out. The importance of them is that every supervisor on the project actually attends. At these meetings, each one brings forward the hazards and risks associated with the work they're going to undertake that day. The interaction between subcontractors is discussed there, so who needs to be in what area and when. If there's any alterations that need to be made to scaffolding, any other works that have to be undertaken, any safeguarding of excavations, any truck movements or deliveries are all discussed at this meeting here. So we can look ahead, and rather than be standing on site looking at a hazard and a risk or coming up with a challenge out there, it's actually discussed in the morning. We know when the deliveries are coming, we know when the crane's going to set up, where the crane's going to set up. These are all talked through, and then if anybody has any challenges or wants to bring forward any concerns, they can be addressed at that meeting.
Every morning on sites we would have whiteboard meetings where all trades would come together and discuss what was happening during the day in terms of what each trade is doing. We would all be coordinated together to make sure safety is, I suppose, predominantly at the top of the list. We would have toolbox talks. All the employees would be called in maybe twice a week. Everybody would be made aware of what's going on around the site in terms of, you know, machinery moving around, what's the highest risk, I suppose, for that particular day. And you know, I think that's very important because, you know, I mean, once employees are safe and they understand what they're doing, I think everything works better, to be honest with you. They can't emphasise enough how important safety is. And I think that's everybody, you know, although there might be time involved in getting all that type of thing right, at the end of the day, I would have to agree that it is the most important thing.
Health and safety is massive with Glenveagh. It should be massive. It's just something that we're all adhered to, we're all tuned into, and it's good on site, but we're always trying to find a better way of doing things all the time with Glenveagh's help.
Health and safety is very, very important to everyone, that everyone goes to work and comes home safe.
Health and safety is a cornerstone of our organisation. We build on it all the time. We build our safety, we build our quality, and we build our customer satisfaction.
As you can see from the video, health and safety is in the fabric of the business. As I mentioned earlier, our offering is built around access, quality, innovation. We want to be the leading innovators in the market, constantly refining, developing and evolving. Our focus is on ensuring that the experience will always be different, and that's what sets Glenveagh apart. I want to give you a real live example of what this means for the business. You all know about our 90 apartment development in Herbert Hill, which we closed last year under a new 25-year government-backed enhanced lease. The first time ever done on a project of this scale. This is a prime example of maximising opportunity, innovation and leveraging partnerships. We had 4 months to bring a totally new concept of product to realisation. We were told it couldn't be done, but we did it. It involved bringing government, local authority and, most importantly, the institution together. The reasons the institution choose us is because we offer access to quality, certainty of delivery, track record and reputation, blue chip backing, which is unique to the Irish market and will drive repeat business. That gives you a scale of this opportunity. Our 3 core segments, suburban, urban and partnerships, are all driven by diverse markets, as I outlined earlier. The customer is core to our business, be that retail or institutional, and we will always constantly evolve to deliver best-in-class product. We have consistently said that we will deliver through standardisation, off-site construction and the use of technologies. Why are these so important to us? Well, productivity in the construction industry has been diminishing for years, and while at the same time the workforce has aged significantly. These are both challenges but also opportunities. At Glenveagh we are positioning ourselves to be responsive to these challenges, mindful of our global obligations to sustainability. Through innovations in our work, we will pioneer new methodologies in the industry and ultimately reap the benefits as a market leader. The team will go through this in more detail later on. That, along with minimising upfront land cost, controlling WIP investment, innovation to control our cost of delivery, all drives shareholder returns. We made a commitment at IPO to create the leading volume home builder in Ireland. In what has been only 2 short years, we've delivered beyond our commitments and what was asked of us by shareholders at the time. All of the key concerns raised by investors when we were a new business with 550 million in cash have been addressed. We have assembled a highly attractive land bank and are now at the peak of our investment trajectory in euro terms, with no net land spend envisaged over the forecasted period. We have already grown the delivery capability threefold and are now committing to do the same and more. This will require continued investment in work in progress, but is necessary to work the balance sheet efficiently. This is not simply growth for growth's sake. It is also not the full extent of our ambitions in terms of driving shareholder returns. We have an ambition to lead the way in introducing structured land acquisitions into the Irish land market. It has the potential to deliver further upside by reducing the group's capital deployment on land. Where possible, we will mitigate WIP investment via forward funding on our urban projects. Innovation is to the fore of what we do, using it as a tool to drive down costs and continue to improve the margin profile of our business. The opportunity remains significant, if anything more than ever. We have a clear path to generating strong returns by continuing to scale the construction operations and allocating capital efficiently. Having completed our net investment in land, that scaling of output will now require investment in working capital. Given the operational climate ahead for the business, it makes good business sense to maintain prudent leverage levels at this early stage of our life cycle. Once there is excess cash available to implement a capital returns programme, we will do so, but not at the expense of introducing financial risk into a business which is 2 years old. We want to deliver a sustainable capital returns policy over the long term. When we will do it right. If excess cash can be delivered earlier than anticipated, we are keen to return it. However, the time to discuss is when it's in the bank. I am a strong believer in the fundamentals. Not only are they highly attractive, but they are also sustainable, as we operate in one of the most conservative housing markets globally. Consolidation and the smaller firms falling to the side is our opportunity to create a leading sustainable home building platform. And we've built the machine for it. Our 3 segments are strategic because they deliver for both our customers and our shareholders. The future is about continuing the good work we have done to date to deliver a step change in return on capital profile for this business. We never look to the past and what we've achieved, only into the future and what we can achieve. I hope today has given you a sense of the opportunity, the capability and the strength of our business and its people. I'd like to show you a video now of the external people who interact with Glenveagh on a daily basis, our subcontractors and our customers.
New families going into a Glenveagh home. Nothing gives you greater pleasure to know that we have built a house and plumbed the house along with Glenveagh, to know that somebody is going to buy a house off them and in turn they're going to make a home with their family from that house.
It's always good to be proud of any of the projects that you're involved in, because the outcome, how they look, the energy efficiency of the home, and the amount of Irish-based companies that you use to manufacture these houses. Yeah, we're very, very, very good to be working with a good builder that always puts out a very, very good product.
It's nice to know the project are involved with the various projects that Glenveagh have, and quite of them are quite prestigious projects, you know, so, and it's nice to see people, you know, moving into new homes and stuff like that, you know, so they're creating communities, to be honest with you.
Like, as a structural engineer, seeing your design evolve always gives most engineers pride. Like, you know, everybody knows what it's like to get a house key, their own home, so to be involved in something like that, to be able to create smiles on people's faces, that I love personally, like, so to be involved in that's fantastic, like.
I suppose when a client will come to you and, you know, they would express their happiness at their new home, and, you know, there's definitely a sense of satisfaction there that you can walk away thinking, well, you know what, I've done a good job, and it's nice.
Hi, my name is Lorraine Hosey and I've been living here in Clonmagadden for the last 4 weeks. We love the Blackwater Park that's local to us here. We tend to bring our dog over for a walk most evenings, just to get out and about and breath of fresh air. The favourite thing about my new home is definitely the kitchen. It's fab. I've always wanted a kitchen island and it's just the dream. Dealing with Glenveagh, they were so easy. They contacted us back if we had any queries. We were never waiting for them to get back to us. It was always prompt responses. It went smoothly, the process from start to finish, which we're very thankful for.
You know, Ireland has some challenges with particularly in the affordable housing market for starter homes. We feel very proud to be involved with projects of that scale, where we know that we're contributing some small part to that solution.
We'd like to take some questions now. Connor is eagerly awaiting to pass the mic to anyone if anyone needs it.
Thanks, Stephen. Sorry, you said that you were going to start using internal resources to deliver the docks. Yeah. I think over time you said that there was probably optionality of using contractors on sites like that. Has anything changed in the market to send you down this route? Is it an economic decision, or is there something else going on there?
No, I suppose as we're scaling up the business, we would have talked about potentially using contractors to deliver the likes of the docks. If anything, you've seen that we have the capability and the skill set to deliver internally now. So overall, we are very comfortable. We've the team assembled. If you all hang on and go through, you'll see the team and the skill set of the team that we now have in-house the capabilities to deliver that. So we're very confident about delivering. It's not a market decision in the sense of where is the market. It's an internal decision that we have the capabilities to deliver. And I suppose if you take the docks as just one example, it's nearly 1,150 units along with the commercial space. It's a 5 to 6 year, 5 year project probably overall. And our ambition is to deliver multiple of these projects, and obviously we want to have that skill set internally.
Stephen, maybe if I can ask you just 2 questions right now, and I might have more later. First of all, in terms of partnerships,
Yes.
you talk about when partnerships get to scale. When do we think that might occur in terms of scale? And then second of all, in terms of delivery, some of your sites are actually quite far forward in terms of off-site manufacturing and the usage of that. We've seen some sites that have some volumetric being delivered. How much faster do you think you can deliver on your sites? Because given the demand from the institutions out there,
Yes.
a prompter delivery would actually be
Yes.
a more, certainly would be helpful.
Thank you, Glenys. So just on the methodology and obviously how we are going to deliver it, we've spoken an awful lot about off-site construction. It is something that we are exploring. We believe that's the way of the future on a number of fronts. Construction industry, between productivity and the age of the workforce, has diminished for years. The skill set is reducing on an ongoing basis. The methodology to deliver it, and you would see some schemes here in the UK delivered it through the likes of Fleming's, off-site modular construction is the way to go. There's a couple of things in factor there. It gives you certainty of programme, delivery, quality, and you know what time you'll be able to get your project. If you think about some of the institutions who are coming in to invest, a big problem for them is when do we actually get the product and when can we put the people into it? So I suppose off-site construction. The ramp up, it's not something we'll be able to do today or tomorrow, but over the next 12, 24 months we hope to be able to bring it as quickly as possible, and then it would hopefully feed into systems. But that's something we're working on. It's not something that can just be turned on like a tap. And the key to actually any off-site construction is, and Peter will talk about it in his manufacturing slides, is actually how you run that operation, because the most efficient manner to run it, and I describe this sometimes to people, is to get maximum output of a factory you must run it consistently at the same pace. You can't go up or go down with it, and the whole idea is you run it at a steady pace, and any excess capacity you pick it up through other alternative methods. So the key for us is, if we were to introduce something like that, is can we keep it consistently fed to a certain degree? In relation to partnerships, and I suppose the base case in the business plan today is the numbers are without partnerships, but obviously we're talking about if partnerships comes in, how it will reduce our overall land bank moving forward. There's a number of processes ongoing. As I said, we'd like to update hopefully later in the year. We're involved in a number of those processes. I didn't want to bring the election into it, but I'm going to be brought into it now. There's a lot of commitments being mooted about potential government parties saying they deliver 100,000 units. I don't know where they're going to deliver, but they say they will. Well, the only way to really deliver that is in true partnerships, and this means where the government are going to have to put their own land up and partner up with the likes of someone like us who has the skill set, the people and the machine to deliver it. I would hope over the next 12, 24 months that we could start to get active if we win some of these, and obviously then they would feed them. I suppose it's probably another 2 to 3 years away before you see those numbers come into the system.
So, and just to be clear on the off-site manufacturing, are you talking about the same sort of approach that Persimmon has, where you will actually manufacture internally, or are you talking about
no,
buying in product?
Internally, we're talking about controlling our own manufacturing is probably where we're going to.
Having your own factory?
Yeah, potentially. There is nothing to say here today. It is something that we are working on, though.
Yeah, thanks everyone. It's Sam Cullen from Berenberg. You've hopefully given the kind of unit splits or at scale of partnerships and urban, suburban, and you've talked about driving Rocky. Can you just put some numbers around those three different divisions and what they...
I suppose we've always talked, and Michael's going to cover this in his slides. He is the CFO. He's much better at it than I am. I suppose, look, you would have always talked about the suburban housing and the land that you would have paid for yourself having a kind of mid to high teen return on capital employed. The forward fund in some aspects, obviously margin profile, what we're seeing is the margin is now more aligned to the suburban, but the return on capital always depends on the forward fund. So the return on capital in that is into the 20s and probably mid to high 20s. On the partnership side of things, and what we're seeing from obviously it's very early days, but the margin is slightly lower than the suburban side, but the return on capital is much better, more akin to something in the mid 30s.
Thanks.
Anybody else? Great. So thank you very much for your input and questions. Yeah, okay.
The new targets, does it, just want to clarify if it includes any of the partnerships?
No, the new targets at the moment don't. So that's just solely what's in the business at the moment. So obviously if partnerships feed into that. But I go back to the point, that is more to replace the land as the land recycles.
Yes, I think to answer the question clearly, it's
Yes,
if the partnerships opportunity materialises, will you see the unit number go up above 3,000, or will you reposition how you're investing in land?
It'll be just how we're repositioning investing in land.
How about the split between PRS and for sale?
It all depends. I suppose we've been talking about this for a while, and look, there's a live example of it. We've seen it in the product that we've delivered last year, and you look to the past, it'll tell you maybe where the future might go. 25% of our book last year almost went to PRS. PRS is not only urban, it's now growing in the suburbs. And there's a growing demand. Like I meet the institutions on a regular basis, and some of the things we're seeing is they've identified two key markets. They've identified the IT worker for a better degree in the city centre, but then they describe it as the sticky income out in the suburbs. And that seems to be a growing demand. And like you look at the transactions that are recently happening, IRES are buying houses, Carysford Capital are buying houses. They've now moved that, and it's probably a phenomenon that has went from the States first, spread to Europe, and is now coming into our market. So there's demand across multiple. To give you an actual percentage, it would all depend on the deliveries through year. But let's say we were doing 1,000 homes, just pure homes, you could see 20-25% of that potentially could be PRS, I think. And then the majority of your urban projects will be all PRS predominantly. It's hard to give you an exact percentage at the moment, though. Thank you. Connor's going to bring you through the market dynamics.
Cheers, Stephen. Afternoon, everyone. As followers of the Irish residential home building market, you'll all be aware that there's plenty of very well regarded commentators on the Irish economy and indeed the Irish housing market. And I can see a number of familiar faces in that regard in the room today. So what we're not going to do is bore you with the minutiae of monthly trends here, but what we would like to do is highlight the key themes that we see in the market and that we believe are going to persist for a period of time, and then align how Glenveagh is positioned against those key themes. Firstly, the Irish economy continues to outperform its peer group. 2020 is set to be another strong year in that regard, with over 5.5% growth forecast by a number of analysts. As you'd expect in an economy that's growing strongly, employment is increasing and wages are rising. In the context of a population with only approximately 5 million people, we've added 500,000 persons to the workforce since 2011. In addition to that, we're running in government budget surplus, and we're also seeing strong FDI. What gives us greater confidence as a business, however, is that almost all of the consumer indicators are in positive territory. We're seeing a continued expansion of real incomes. Retail sales remain robust, but at the same time, savings rates are exceptionally high. We're all aware consumer confidence did take a breath at the time of the Brexit debate, but that's now pointing in the right direction as well. At the same time as we're enjoying a very strong overall economy and consumer environment, We're also in the midst of a period of significant population growth. A country, with 5 million people, is expected to add close to 500,000 persons by 2030. It's that population growth that is the foundation of the housing need in Ireland and all of the stats you hear in relation to the number of deliveries required. A report published by the Central Bank of Ireland late last year puts that housing requirement at 34,000 for the foreseeable future. That assumes that the level of inward migration, which can at times be volatile, continues at its current pace today. But what it also assumes is that headship rates in Ireland remain static. Headship rates in Ireland are one of the highest in the EU. Ireland's headship rate declined rapidly as we went through the 1990s and early 2000s. But as soon as the financial crisis hit, at the same time as headship rates continued to decline in Europe, Ireland's actually increased. So what drove that increase? We didn't all suddenly decide that we wanted to put more people in the same number of houses. What you had was the outside of Dublin, that headship rate continued to decline in line with preferences and in line with what we're seeing on our sites, where the highest demanded product is the 2-bed product. But within Dublin, due to the shortage of housing, particularly the younger cohort, stayed at home and are living at home longer, not out of preference, but because there simply isn't the accommodation there. Were Ireland's headship rate to converge with that of the EU, this would bring additional demand on housing above and beyond the central forecast of 34,000 per annum, and would in fact require 47,000 houses per annum. But the message we'd like you to leave you with in this regard is, we're confident that we can deliver the 3,000 units on any of the demand scenarios set out by the central bank because of the structure of the industry today. At our peak delivery of 3,000 units, we'll still be less than 10% of the market, given the base case output targets. What on the face of it would appear to be a very nurturing environment for the supply side. The supply side, as Stephen mentioned, continues to struggle to scale up. Unlike the UK, where when the financial crisis hit, balance sheets were resized, land banks got written down, but ultimately home building continued. In Ireland, the entire supply side went out. We continue to build one-off houses, and that's what you see in the numbers. But estate housing effectively dropped to zero. By the time green shoots arrived, equity returned to the market, there was a semblance of debt. The environment for home builders had moved on significantly. 2 to 3% cost of funds was replaced with 10 to 15% cost of funds. 100% loan to cost was replaced by 40% loan to cost. And compliance and regulation also moved on, and the sector was forced to professionalise, and that brought with it costs and a way of working which were unfamiliar. Again, as Stephen noted, the UK market has consolidated around the larger home builders. 80% of the builders producing less than 100 houses per year left the market in the UK between 1998 and 2015. We expect and we see the same happening in Ireland. It's not that there's a need for M&A. There are few scale players to acquire. It's that the structure of the market today makes it very difficult for that smaller home builder to build a sustainable business. As the chart demonstrates, there's very few home builders producing more than 200 units per annum. Ourselves and Cairn are 2, and a number of others that continue to be supported by NAMA. One of the advantages that the macroprudential rules have brought is that they've created a very sustainable and robust environment. As you can see from the charts, first-time buyer on the left, second and subsequent buyer on the right. New loans are hugging the limits outlined by the central bank. As a result, again as Stephen alluded to, the central bank believes that prices are 26% below where they ordinarily would be were the rules not in place. These rules are low by international standards, the UK operating at 4.5 times. Taking a medium-term outlook, our view is that given the clustering around the 3.5 times limit, that HPI is likely to at least equal wage inflation for the foreseeable future. And that's obviously absent an expansion of the likes of Help to Buy, which has been mooted by the government parties. Our experience of the mortgage market is that these LTI rules haven't tempered banks' lending appetite. They've just set the parameters for it. We're not only signing, reserving units, we're closing them with the help of our banks. And we're building closer and closer relationships with these banks. The message we'd like you to take from this slide, and I know we've had new statistics out today which are positive, but we're clearly seeing on the ground, if we can continue to deliver product at less than 3.5 times income, there's ample finance available in the market. The extent to which there's the ability to pay beyond the 3.5 times limit is best demonstrated by the rental market. Here, the cost of renting is significantly above the cost of ownership in practically every market in the Greater Dublin area. This has contributed to the emergence not only of an urban PRS market, but a suburban one as well. The strong economy, underlying demand for housing, has attracted significant institutional interest to the sector. We are seeing yields tighten, and sellers of PRS product like Glenveagh have actually benefited from the introduction of rent stabilisation measures. Our experience from our recent processes is that if you can create greater certainty around a rent, that tightens the yield, which is ultimately more valuable than rents racing ahead, which are harder to underwrite and therefore priced accordingly. It's also important that the product delivered is at sustainable rental levels, which again helps tighten the yield. Due to the lack of supply in the PRS market, transactions were initially focused on standing stock. Increasingly, investors are entering into forward commitments and forward funding arrangements, the shape of which Michael will take you through later in his presentation. What excites us, having run a number of processes, is the sheer volume of participants looking to get access to rental product in Dublin and the suburbs. Outside of the top 2 or 3 that you see in the bar chart, very few would argue that they're not in need of finding additional product to capitalise on the advantages of scale. 3.5 to 5,000 units is often mooted as the ideal number. One other point to note is that despite the continued requirement from occupiers and despite the investment of the institutions, the number of PRS properties in the market continues to decline. As Stephen noted, the mom and pop landlord is exiting. Why? Because of the onerous taxation environment, because of bank deleveraging, because of increased regulation. So we need more supply and we're getting left with less product despite this institutional investment. Putting all of that together, we believe that's why PRS is a market that's here to stay in Ireland. So what does that mean for Glenveagh? We're operating in one of the best performing economies in the EU. The consumer environment is very healthy. Demographics and population growth are driving a housing need. This need is not being met by the supply side. Our approach to tackling these unique set of circumstances is threefold. We're delivering volume to the deepest segment of the market at prices that are financeable in the market. That's starter homes at less than 325,000. We're working with institutions to deliver quality product at sustainable rental levels. We also recognise that not everybody that needs a house can afford a house. That's why we're partnering with government, local authorities and other institutions with a view to delivering product on their lands to capture those outside of the affordability net. It's this three-pronged approach that we believe will ensure that Glenveagh is best placed to capitalise on the key themes that we see persisting in the market for the foreseeable future. I'd now like to welcome Wesley up to talk about our land investment. Thank you.
Good afternoon, everyone. Just getting a glass of water here. I'm Wesley Rothwell, Chief Commercial Officer with a responsibility for the land portfolio, which includes identifying investment opportunities for the business within the segments which Stephen has mentioned. As previously mentioned, the team has deployed over 700 million on land acquisition, and equally importantly, during that period, we've reviewed over 2 billion of assets, which we haven't pursued for a variety of reasons. To put this into context, for every 10 to 12 assets which we review, we would actively engage on 1 or 2. Later I'll take you through a detailed overview of the processes and procedures which we adopt in identifying, reviewing and acquiring lands. So looking at the segments, the investment team is focused on these three segments of the land market, namely suburban, urban and partnerships. Investing across these three segments allows us to optimise the return profile of our investment and utilising the group's construction expertise. So firstly, looking at suburban. If we consider the suburban and urban markets in 2019, in excess of 1.2 billion of land traded in the year, which is consistent with 2018. And we will anticipate a similar volume to trade in 2020. We're sourcing the majority of our opportunities off market, and we're seeing a steady flow of opportunities on market as well as off market. And again, we expect this to be consistent throughout this year and into next year. The profile of purchaser has evolved, however, over the past 4 to 5 years, from opportunistic high net worth investors and developers to developers funded by PE funds to a more tiered structure in 2020, where we're now seeing limited demand for opportunities in excess of 10 million, with smaller family offices focused on the sub 4 to 5 million market. And again, we expect this trend to continue, as mentioned by Stephen. There are multiple exit options in the suburban market, focused on owner-occupier, social housing, and a newly evolved trend of institutional investors looking at the suburban sector, as Conor has alluded to. So looking at the urban market, there's no doubt that during 2018 and 19 we experienced competition for urban sites, which were a focus for the PRS sector, and we expect this to continue. The profile of bidder included investment funds, local specialist operators and developers partnering with international capital. We have the opinion that there's a significant amount of these assets that have traded over the past 2 years may not be delivered, and an opportunity may present itself over the next 12 to 18 months to use the advantage of the PLC covenant to extract value from these assets. So for example, working with the landowner on a JV or a structured deal. So turning now to partnerships. We're currently involved, as Stephen has mentioned, in a number of active processes, which we expect will be awarded during 2020. We believe that as the land market continues to evolve over the next 2 to 3 years, that the partnerships will grow in significance. And this has been driven by state entities such as local authorities, semi-state entities, and the newly formed Land Development Agency. And I'll bring you through shortly some more detail in terms of the potential pipeline that's in the partnership sector. Each of these three sectors are important to us here in Glenveigh. And while there are nuances in each of them, the ability of the business to maximise our return on capital by reducing our investment in land will grow output. So looking at our portfolio, over the course of the past 2.5 years, we've assembled an excellent portfolio of land, which falls within the three segments. Our portfolio is essentially Dublin-centric, 90% in the Greater Dublin area, with a particular focus on the deepest segment of the residential market, namely the starter home, sub 325,000. In addition to affordability, we placed a significant emphasis upon transportation hubs and employment. And this is further demonstrated with 69% of our portfolio in the suburban locations. As I've mentioned, and as we've previously discussed, we're focused on assets which have multiple exit options, which is demonstrated with 15% of our portfolio having either a private or a PRS exit, and we expect this trend to continue as the investor continues to enter the market. So a fundamental driver in assembling our portfolio to date has been our focus on the deepest segment of the residential market, the starter home, combined with affordability. We're continuing to experience population growth, particularly in the main urban centres, which are a focus for Glenveigh moving forward on future acquisitions. We have the opinion that the demand, coupled with projected population growth, that the starter home market has the greatest potential for HPI. So an important part of our portfolio assembly to date has been our focus on the market in Cork. Designated Ireland's second city, 2 hours by car and train from Dublin, an international airport, an extremely young and dynamic population, and a significant emphasis upon pharma and IT. If you Google why live in Cork, you'll find the following: an attractive jobs market, the cost of living, the way of life, and the culture. These points demonstrate why Cork has been such an important market for us in Glenveigh. We've assembled a portfolio of 5 assets which have the potential to accommodate in excess of 2,100 plots, focused on both the build-to-sell and the PRS sector. While this comprises in excess of 14% of our land bank, the average plot price is extremely attractive. We believe there's a significant opportunity for us in Glenveigh to become the dominant house builder in Ireland's second city. So I've mentioned the pipeline in the partnerships area. So this, in addition to the traditional options of procuring land on and off market, we see partnerships as being accretive to the business, as it offers alternative delivery options, it complements our existing land bank, and it contributes to the key financial metrics of our business. Partnerships have been a feature of the UK market over the past 10 years and have been adopted by such entities as Countryside. The existing pipeline of opportunities is strong, and we anticipate that this will grow, as we've alluded to, over the next 12 to 24 months, as the government encourages mixed tenure opportunities and exits by state entities. As I've mentioned, we're at the advanced stages in 2 processes, and we expect these to be awarded during 2020. So we're continuing to see a strong volume of opportunity on and off market in each of the segments of our business, and we expect this to continue. And I think a key focus for us in the investment team is to really assure the following. The profile of asset that we're looking for, that the location fits the acquisition criteria of our business, that the asset offers multiple exit options, that the asset meets the key metrics of our business in terms of margin and ROCE, which have been discussed today, and the capital allocation in particular geographical locations. So we delve a little bit deeper into this. What we've done is we've created essentially 4 categories in our land market and a sector when we're looking at opportunities. The first of those, or the first 2, category 1 and 2, have been a particular focus of the business to date in terms of identifying, in the case of category 1, assets that have full planning permission, whereby we can deliver units within a maximum of 14 months. The second are lands which are zoned with fully serviced, where we hand it to our planning team and we bring it through the planning process, and we can deliver units within a 30-month period. The additions to that now are focused on the category 3 and 4. So category 3 is a hybrid of 1 and 2, and it's based upon phased payments linked to a phased drawdown of the lands. There are obvious benefits to us as business in terms of our ROCE and our deployment of capital. It is important to realise, while this is a concept which hasn't existed to date this is a concept which has existed in the UK, it's something that hasn't existed in Ireland, and therefore it's important for our ability to utilise the strength of the PLC to extract these opportunities in the market. So turning to category 4, these are strategic long-term acquisitions, and these are focused on areas where the potential rezonings of land in time in a period of 4 or 5 years. Again, if we can procure one of these assets, there's obvious benefits in terms of the advantage and the underlying land value. So I suppose we've a disciplined approach to land acquisition and selection, and really we've broken that down into 3 key steps. I suppose the first of those is identifying the key area. So with a focus on employment, demographics, transport, schools, absorption levels, all of those things as being key components to selecting the area and why you should go into it. The second, once we've identified the area, we focus on who are the owners. So we sit down as a team and we say, right, who are the owners of this land in this particular location? And I suppose what that allows us to do is be strategic in our approach in terms of who we're targeting, how we're targeting them. And again, we're ahead of the posse on that front. I suppose the third is, once we've identified the location and we've identified the lands and we're engaged regarding a potential acquisition, the investment team, in conjunction with the internal teams within Glenveigh, prepared a detailed assessment of that asset. Once we've done that and we believe it's an asset that we want to advance on, we at that point engage with external consultants, so architects, planning consultants, surveyors, engineers, solicitors, etc. And at all stages in this process, we regard to the key financial metrics which we've alluded to today, and equally importantly is the delivery matrix. So while I've briefly outlined the forensic approach which we follow in acquiring lands, it is important to realise that at all stages in this process, it's not just the investment team that are reviewing these opportunities. We're fully supported by the overall business. So, and the planning team, our infrastructure team, our procurement team, our QS team, construction, sales, finance, etc. And that's extremely important to us on the acquisition side of the business. So as part of this engagement with the internal teams, we obviously we've internal and external processes around that, and we have pre and post acquisition meetings and reviewing of assets. And again, this is a critical part of the process which we go through in procuring our lands. So in addition to these meetings, and once we've identified an asset and it's been brought in, our team would then obviously support the other parts of the business in terms of the construction team, the sales team, and the planning teams. So I could leave you today just with 3 key messages from the investment team. We're seeing a volume of opportunity, and we have a disciplined approach targeting the 3 segments. We have a quantum of capital whereby we're focused on particular locations and particularly on the first unit delivery, and the importance of multiple exit options. So, Connor?
You done?
Yeah.
Great.
Too quick?
He changed his ending.
Keep you on your toes.
Right. We're actually making very good time. So we might break now, and if people could maybe start filing in about 10 to 3. We're very excited with the next half of the presentation. We have the operational team are going to take you how we're going to get to 3,000 units. And then Michael is going to outline what all that means for shareholders. So see you all back at 10 to 3. That'd be great. Thank you.
Welcome back after the break. My name is Peter Gavican, and I'm responsible for planning, manufacturing and design operations. So over the next number of slides, I'm going to take you through our holistic approach to planning and design operations. I'm going to speak about our manufacturing culture, and I'm also going to speak about pioneering a new way in terms of integration right across the supply chain. So moving into our planning and design function and our holistic approach, we consider planning and design around the principles of consumer requirements, placemaking, regulatory and delivery. In terms of consumer requirements, we consider institutional and retail consumers and customers in terms of what their ask is of us, what their needs are in terms of private and public open space, in terms of fit and finish, in terms of layout. But on top of that, we look at the latent needs of the customer. And when I speak about latent needs, I speak about the needs that the customer might not know they have. And a practical example of this is our heat pump technology. We use heat pumps in our suburban developments in our houses now. And often, on open weekends, consumers and customers ask us, what is the apparatus or what is that piece of equipment in the back of the house? We explain it's a heat pump. And a number of months later, after using the heat pump, becomes apparent the convenience of the heat pump is a must-have now for those consumers. So we're constantly looking at pushing the boundaries in terms of innovating our house and scheme design and looking at those latent needs of the customers. In terms of affordability, Stephen has mentioned it and Connor has mentioned it. In terms of design principles, we've brought a new dimension into design and working with our design teams. So it's not only about designing a house or designing a residential unit and fitting with regulatory compliance. It's also about looking at affordability in the area, the macroprudential rules, the 3.5 times income. That's a key component of our design influence. Placemaking. We've recently engaged a design team here in the UK, and to make an interesting analogy, everybody considered and thinks about where they're going to live. How many people consider about where the house is going to live? So what is the architecture in the surrounding environment? How are we representing that in our schemes? How are our schemes fitting in with the natural surrounding environment? How are we leveraging public open space? And how are we leveraging infrastructure in the surrounding environment? Do we consider the requirements of the urban and the suburban surrounding environment throughout our design process? Moving on to a regulatory. In Ireland, most of you are familiar, we have a number of plans and regulations in terms of our obligations to fulfil on developing out a residential delivery. And that can be across national planning framework, development plans and local area plans. And sometimes there can be inconsistencies across those plans, but there's a drive now on at policy level in terms of bringing consistency across those plans. And generally, The policy is providing an urbanisation of the suburban locations and a higher urbanisation of the urban locations. So they're trying to consolidate towns and bring vibrancy to town and village centres. So therefore the suburban development now, as Stephen alluded to earlier, has a component of low-rise urban product. And while we are obliged to comply with policies, we see ourselves as a trusted partner. So we get involved in dialogue, in the formulation of policy, through submission, through public consultation. And it's our function to work with the policymakers and informing them what the consumer requirements are, what the viability issues are, what the macroprudential rules mean in terms of forming policy that derives a certain density, a certain percentage of private and public open space. In terms of construction regs in Ireland are at NZEB level, near zero energy buildings. So it's almost at that holy grail of the housing unit becoming a net contributor to energy rather than a net consumer. NZEB isn't a problem for us because we've been there and we've been there a long time at this stage. We've been there well over a year. So NZEB isn't a problem for us. We're aiming above NZEB. What does that mean for us? What do our design teams need to engage now in terms of bringing our houses above NZEB, our residential units above NZEB? What does that mean for our construction teams? The reason we're at NZEB at the minute is because Tony and Fergus, who you'll hear from shortly, their meticulous attention to detail means cold bridging, air tightness, etc. is robust in our housing developments. So we're pushing the boundary to go above our NZEB, which leads on to delivery. In terms of delivery, manufacture and assembly is a common word across industry at the minute. So our design teams automatically will accommodate manufacturing and assembly, and Stephen spoke about manufacturing earlier. Our manufacturing at the moment is in terms of timber frame and moving on to 2D steel, which Fergus will speak about in his urban apartments. In terms of that manufacturing piece, we have supply agreements with our manufacturing partners. So our design and our design influence right across the housing units and the scheme layouts will firstly drive efficiency in the manufacturing operations on those manufacturing partners that we have supply agreements with. So we consider manufacturing and assembly as a key component of our design suite. Also in terms of layout is very important to us, and layout is very important in terms of getting a good return on capital employed. How can our construction teams work to get proper layout, proper phasing moving throughout the development? How can pedestrian traffic and construction traffic coexist safely on our site? You saw the emphasis by Stephen on safety. Safety is critically important. So our design teams are challenged, looking ahead and see how that layout function works. Something I want to speak about is ground. A lot of innovation in recent times in housing has gone into the product itself and the NZEB level of almost passive now indeed insulation. We're looking now at ground, and we're looking at ground in terms of how ground can work better for us as a business, how ground can add value to the consumer or value to the bottom line of our company. In terms of the regulatory requirements, as I spoke about, there's a certain density that the planning authority will determine you must make. There's a certain amount of public open space and a certain amount of private open space. And then there's ground. So what ground is left over? What can we do with that ground? In the traditional component type that's used in Ireland, the 3-bed semi, the 2-bed townhouse, the terrace unit, and the apartment product, typically in suburban developments now, you're looking at a split of 55% suburban type product and 45% urban type product, because you must meet a density while maintaining your private and public open space. So we're looking really hard at that, and we're looking at what if we don't use a traditional product that is in the sector? What about we use a product that will tap into the latent needs of the consumer that I spoke about earlier, and a product that will satisfy the needs we know that exist. And those needs we know because that comes back to our sales team from Ronan McKenna that's here with us today. So we're innovating that product type, and the first release of that will be tomorrow, back into us to see what that looks like with our construction team and with our viability team. But it means we're pushing that 55-45% split. We're pushing that now to 75-25. So 75% of a suburban product in a suburban location and 25% of an urban product in a suburban location. And that's a real game changer. In terms of our design teams have been challenged now, not only in terms of designing and delivering units according to regulatory requirements, but designing within a set of commercial parameters. designing to make sure that delivery of that unit makes an exit at less than 3.5 times income in that area. Design has gone beyond just designing houses for the sake of regulatory compliance. Designing on standardisation and making sure that those designs work for our construction team. Moving on to standardisation. Standardisation is a potentially dangerous word in terms of the perception of it. Is the perception of standardisation, does that mean there's going to be standardised housing developments produced by Glenveagh? Not at all. We bring standardisation to component level. We bring standardisation to standard specs. We bring standardisation to standard housing layouts. But we do not have standardised housing developments. They are contextually different in every case and sympathetic to the environment that they are in. To coin a phrase from Stephen, Volkswagen use a similar chassis for their Golf, for their Jetta, for the Tiguan, but they're different cars. Similar approach with ourselves. We've standardised housing floor plans, standardised specs, standardised components, but we've different outputs. While we believe there are efficiencies in standardisation, there's no doubt, it's also incumbent upon our manufacturing partners to drive efficiencies in their business. And then we're maximising efficiencies. Efficiencies on the standardisation of layouts and housing units will get you so far. The manufacturing business, by adopting manufacturing approaches on just-in-time inventory management, single metal exchange and die, that will drive the efficiencies even further, and I'm going to speak to you about that shortly. So the challenge on standardisation. Develop our standardised suite of components. Make sure we're compliant with the regulatory requirements of the planning authorities. Make sure the planners and the planning authority and their subjective opinions accept that we're contextually different on our housing schemes, and making sure our base case requirements on business in terms of margin and return on capital employed are maximised. Standardisation cannot happen and does not happen with the planning and design team alone. It happens with the input of construction, with sales, with our viability teams, and with our land management teams. And just to mention, we currently have a number of standardised units. We're using them each and every day in our business. And as I said, tomorrow we have a new release of a new product into our own company that we feel is going to be a game changer in terms of working our ground harder. I want to speak to you about manufacturing and our operations culture. And I'm going to speak about it in terms of decision making, integrating the supply chain, and finally costs. In terms of decision making, we're using a process called sales and operations planning now in Glenveagh. And sales and operations planning relies around a demand forecast, a robust set of figures that comes right from demand forecasting back to our construction supply chain, back to our manufacturing partners, and into their suppliers. That's one set of data, one single set of data, and it's derived from demand forecasting by our sales team on all our various sites. So to put it simply, if we have 20 sites open and we have 5 standard house types, how many of house type A, B, C, D, and E are going on that site, and when are they going on that site? Through the construction programme. That's pulled back into our manufacturing business. The manufacturing business, which we have a supply agreement with, knows how many of house type A, B, C, D, and E are going each one of our 20 sites and when they're going there. That's pulled further back to their raw material suppliers, i.e. the timber frame suppliers. They know how much material the manufacturing business needs to push through that supply chain. That supply chain integration is something we're pioneering in Glenveagh, and we're finding that that's gaining significant efficiencies in the operation of our business. So it's an integrated business model that's bullish and even selfish on accuracy. It drives efficiency, it thrives on continuous improvement, and it's relentless on productivity. The strengths of integrating the supply chain through our current supply agreements are that we can give demand accuracy. We can give certainty on demand. We know, given the housing difficulties in Ireland at the moment, once we're lower than the 3.5 times income in that area, there's a demand. The question is the demand for what? Is it a demand for the product that the planning system is forcing developers to produce, or is it the product that innovation, while remaining within the framework of the planning system, that we produce that the consumer wants? And it's the latter for us. In terms of sales and operations planning, and I'll leave the slide with this, sales and operations planning as opposed to planning, operations and sales. Planning for the sake of planning, for getting your planning permission through the regulatory process. Moving on to operations, who have a look at that planning and decide that layout doesn't work from a construction perspective, that layout doesn't work from a return on capital employed maximising perspective, goes back into design team again for replanning. Sales take a look at it, and sales say that 3-bed, 4-bed unit in the corner won't sell, we need to change that. The traditional approach to construction. That's planning, operations and sales. We've moved sales and operations planning. One set of numbers, demand forecasting. So, why off-site construction? Because it's not construction, it's manufacturing. So why manufacturing? Well, manufacturing, not because of the shortage in labour. Manufacturing because of the attributes that's inherent in manufacturing. Productivity, quality, tolerances, fit and finish, design, health and safety, removed from inclement weather conditions, removed from the inherent difficulties on site of dust and contamination. Once we move through that process, then off-site manufacturing, or off-site construction if you want to call it, becomes cost-effective, becomes efficient. On all of those attributes, you can define, measure, analyse, improve and control on every single one of those attributes, and that's taking a manufacturing approach to off-site construction. That manufacturing approach is optimised year on year, all the time. And working with our manufacturing partners at the minute, through our supply agreements, I'll give you an insight at the end in terms of the optimisation we're doing on that. And for all the consideration and talk about off-site manufacturing, it does exist today, and it exists in timber frame manufacturing. It exists in component design. I remember the days when windows came to site and the pane was put in site and putty put on top of it. Now triple glazed alu-clad windows are coming as one unit to site. Our timber frames are coming to site as a manufactured product. So, to sum me up, exploring ways to build closer links with our supply chain. We believe if we continue to innovate, continue to work closely with our supply chain partners, continue to optimise our design, continue to force that innovation on the product within the realms of the regulatory bodies, that we will gain the efficiencies on programme, cost, quality, health and safety, and certainty will be guaranteed. A couple of examples, because there's been a lot of theory. So, Keenan Timber Frame, who you've seen in a video already, they have a supply agreement with us, and in that supply agreement we share plenty of information, so we have a good idea on how their process operates. Okay, on that supply agreement, we've had our procurement director get involved in negotiating some of their material prices. Richie Caldwell is here today. We've negotiated a 35% discount on insulation used in Keenan Timber Frame that's passed directly onto our bottom line. Why? Because we can give certainty in demand and volume across our supply chain. Another example with Keenan Timber Frame, their timber came from Scandinavia at a point in time. We went up, we looked at their manufacturing line, we made some improvements in terms of efficiency of product flow, but we also suggested, given that we are Irish and there's plenty of timber in Ireland, could we use some Irish timber? We visited an Irish supplier, and it now turns out the Keenan Timber Frame are using timber from an Irish supplier for the stud walls. In terms of that supplier of timber, of raw material, Keenan Timber Frame, the manufacturer, was amazed by the system control and data acquisition systems they had placed in their product line. 100% monitoring on moisture control, 100% monitoring on knot content on timber. So the quality is exceptional. And the impact is profound in that the lead time on that timber now is a matter of hours, 3 hours down the road, as opposed to weeks from Scandinavia. The payment terms remain extended. So in all fact, the fact of the matter is that timber is in through a manufacturing process on site and being constructed before it's been paid for. So there's a couple of examples on our supply chain. I'll speak to you about a quarry, a disused quarry. Inert material being removed from site is something that is contentious at the moment in terms of Irish regulations to make sure there's no contamination leaving your site. So once soil, inert material is tested and it's proved to be okay, there are facilities that will take that soil off you. And that's a cost that we see rising. And Michael's going to speak to this shortly. We've bought a disused quarry. We're using that to take our inert material. So now we've hedged our costs on the exit side of that. If there's surplus capacity in that quarry in the future, we can open it up to third parties and get a return on that. I've shown you integration from suppliers to our suppliers to an exit on inert material. And in the near future, we'll be making a significant announcement in terms of further integration and further innovation right across our supply chain. So I'm going to leave you on a quotation, and the quotation is disputed whether it's Darwin or Messingson, but it speaks about it's not the strongest or the most intelligent that survives, it's those who are able to change. And Stephen opened his presentation earlier today about changing and the structural changes and reforms that were across the construction industry. I've spoken about we've changed standard designs. I've spoken about we've new standard designs coming tomorrow. I've spoken about our sales and operations planning approach to our manufacturing business. I've spoken about our design teams. Our design teams challenge now from a commercial perspective, not only design. So finally, each day in our business, we innovate, we integrate, we consolidate, and we win. So I'm now going to hand you over to Tony. Tony's going to speak to us about construction on site and the good relationships we have with our subcontractors.
Thank you, Peter. I'm Tony McLaughlin and I'm Head of Suburban Delivery at Glenveagh. Today I'd like to update you on the progress we've made on developing our supply chain and how we're implementing technology so that we can continue to scale our business. As Stephen has mentioned earlier, our construction delivery is split into two components, suburban and urban. Why? Well, we recognise that the delivery of these two elements, as Stephen has touched on, require completely different skill sets and competencies. We know what our teams can do. We also know where we can make improvements to optimise and specialise within our business. We firmly believe in hiring the right people to do the right job and empowering them to get it done. Going forward, our suburban developments will centre around traditional, greenfield, low-rise residential houses and apartments. We have and continue to complete high-quality schemes of this nature, such as Cushlasson and Taylor's Hill, which you've seen earlier in the videos. Our urban developments will focus on brownfield sites, providing high-rise residential schemes. We've recently completed examples of these in Marina Village in Greystones and Herbert Hill in Dundrum. My colleague Fergus will go into further detail on these and a few more a little later. Key to our continued successful delivery is not only the 330 employees we have within the business, but also our supply chain of 2,000 people on an average day. The fallout from the recession saw much of the industry supply chain overexposed financially. This, along with restricted credit in the market, meant that there were numerous stop-start developments, leading to a reluctance for subcontractors to scale and grow their business. At Glenveagh, we've taken a partnership approach with our supply chain. We provide them with clear roadmap of annual targets across multi-phase projects. We can ensure consistent and coordinated work and give them the confidence to scale their business with us. Since IPO, we've put significant effort into growing our supply chain. We've worked hard with our subcontractors and now they understand and believe in the Glenveagh way. What is the Glenveagh way? That's our standard expectations, it's our processes, it's our procedures that we require across all of our sites. It includes site setup, health and safety, environmental requirements, procurement processes, our quality expectations, amongst others. With this in mind, I'd now like to show you a short video of how our partners view working with Glenveagh.
When I first started in 2014, it was myself and another engineer, so working with Glenveagh over the last couple of years has allowed me to grow and give me more confidence, I guess, like to employ people.
We've been working with Glenveagh since 2013. We would have been probably only myself and two apprentices at the time, and then when things progressed and Glenveagh obviously expanded, our own company expanded.
Glenveagh is allowing my company grow to where it is today.
It's different working with one of the big players. You know, you have to up your game, up the ante, but it's been really, really good.
Glenveagh are very, very well organised, right from the top to the bottom. It's clearly set out from the office what is the scope of works, so that we can clearly set that out to our staff to say that it's all organised when it comes to site and everything runs smoothly.
Well, I think Glenveagh really transformed the building industry in Ireland because of their approach to it. They have a dynamic team. They also have, they're very open to new suggestions and solutions on how the building industry should progress to the future.
They know the direction that they want to go, and they have a niche in the market. They sort of tick all the boxes and all the various house types they try to deliver to the different types of the market.
They are extremely competent at what they do, adopt a very professional attitude, and we enjoy a close working partnership with them and with their procurement team and their site personnel.
Cash flow is key for us to expand in our business in terms of paying suppliers, in terms of paying wages, and just basically building the business. And I suppose, you know, the big attraction with Glenveagh is because obviously of the output that they're producing. We know going forward, you know, we would have at any given time, we would always be looking 6 months to 12 months ahead, which is massive for our business because we can grow our business knowing, you know, once we put a valuation in at the end of the month, payment is always there, it's very prompt.
We have to be ensured that payment is there when we need to be, to pay our suppliers, pay our subcontractors, pay our direct employees. So it's very, very important to know that the finances are in place and there's nothing to worry about finances so that we can get on with what we do good.
The certainty for suppliers, not alone KTF, for subcontractors, we find that a lot of suppliers, subcontractors sort of migrate towards us because they know that we're working for a client like Glenveagh. So the assurance is always there for those people as well.
When I'm planning with Glenveagh, I'm planning for not just this year, next year, the following year. And a lot of the projects that I work in would be 3-year programs because there's only so many houses you can deliver per year on a particular site. So for me, as I said, there's safety. When I'm talking, employing somebody, I go, here's the project. Not alone, this is a 3-year project, which means if you stay with me, I know we're okay for the next couple of years from a financial point of view.
It's a centralised procurement process with Glenveagh, so you tend to work with the same people in the office for every project, no matter where that is. So you always know the person that you're dealing with and you always get the outcome that they want and what you also want as well.
When we have that knowledge of the 20 sites and more to come, it allows us to also achieve greater economies of scale, that we can deliver cost savings when they're based on the fact that the volumes are higher. It allows for cheaper prices, I guess, for quality materials.
When we started to deal with Glenveagh, where a lot of previous builders we would have been dealing on site, whereas everything is done through the office now of Glenveagh, you know, it's a better system.
When you're dealing with one procurement team, there's obviously relationships and work practices, and personnel will build close working relationships and an understanding of each other's requirements and style.
The relationship with Glenveagh is really, really good at the moment, and again, down to the certainty of numbers that they have coming in, it's going to get nothing but better.
We look forward to working closely with everyone in Glenveagh and to being a remaining part of that journey and to be a trusted partnership working closely towards their success in the future.
We're 20 years in business now, last year gone by, and we have a 40-year plan in front of us, and we need to be working for the people that know how to build houses, know how to produce houses, and keep the staff going that we have already on the books, and maybe expand on that as well.
Our business is growing hand in hand with Glenveagh, what they're trying to achieve. And, you know, that's the big thing for us. You know, we all work well together. It's exciting times.
As you can see in the video, we work collaboratively with our subcontractors and they have a growing desire to work with us. One of the key areas that we focus on to enable them to scale is credit. To reduce the effect of restricted credit within the system, we've taken the decision to centrally procure all or majority of our high value items that we use each and every day. Items such as heat pumps, sanitary ware, insulation and plasterboard are free issued to our subcontractors, so as to reduce their credit requirements. As a result of this and other initiatives, we've been able to maintain and indeed at times reduce the cost of our subcontractor packages. In particular our mechanical, our timber frame and our dry lining, some of which you've heard about from Peter earlier on. Back to the video. Knowing that Glenveagh has the ability to pay and pay on time reduces the need for the subcontractors to avail of discounted invoicing. This in turn leads to more competitive pricing for us. Subcontractors are now targeting Glenveagh for business and they want to work with us. In the last 15 months alone, we've been able to add 191 approved partners to our panel. Put simply, this means that despite growing to circa 20 sites, we now have more people to pick from. To become an approved partner with Glenveagh, we assess a range of competencies, including health and safety, resources, quality and previous performance, amongst others. During the tender process, we consider these factors, along with price, to ensure that not only do we get the best value, but also desired performance. This process also ensures we don't have a reliance on any single contractor. There are many obvious advantages of maintaining a substantial supplier base. Healthy competition, minimising cost inflation, and it facilitates our continued scale and our ability to open multiple sites together at the same time. Our ambition and clear roadmap to scale gives us substantial opportunities for strategic partnerships and long-term procurement options. Our ability to bulk buy and enter into long-term agreements has multiple benefits. As Peter referred to earlier, by streamlining our specification, we now realise economies of scale. We can now provide higher quality premium products at very competitive prices, ultimately providing a better home for our clients. We can provide maintenance plans and meaningful warranties for our customers, giving them further peace of mind with the sale of our homes. We can control material costs for the duration of projects and minimise inflation risk. Ultimately, we can maintain and manage a sustainable supply chain as we continue to grow. We have and continue to see the positive effect of this strategy, particularly in packages such as kitchens, appliances and heat pumps. At Glenveagh, we have a centralised procurement approach headed up by Richard Caldwell. As a result of his hard work and the work of his team, we get the benefit of a portfolio-focused strategy and avoid a silo approach from any particular site. We plan just-in-time deliveries to manage logistics and help minimise our carbon footprint. Where possible, we work with local suppliers so that we can provide local employment. For our suppliers, the knowledge that Glenveagh has the ability to pay and pay on time reduces their requirement for credit insurance, and this encourages more competitive pricing also. Along with a sustainable supply chain, we're utilising technology to enable continued growth and actively manage cost, quality, health and safety and programme. Our aim is for a more connected construction, as I hope you'll see in the following video. Our ambition in Glenveagh is to be innovators and market leaders. In Glenveagh, we're very lucky with the people we have in the business, and the people have really driven the technology. We have a collaborative environment where everybody's on the same page. To facilitate our coordination, we use the AConnect platform. It's an online platform that's accessible to everybody within the business. We use multiple modules from document control to health and safety. We use the tendering section to ensure a transparent tendering procedure that's fully auditable. We use the supplier's packages to ensure our documents are contained and managed and we're fully compliant at every stage of the process. And we also use workflows, and workflows streamline our process. We use technology to help us collaborate, from health and safety to quality management. We use AConnect Field. That's an on-site mobile app that empowers us to inspect, observe and identify and raise any positive or corrective actions that may occur. That provides a platform with both the office and our designers. The technology we use to control our sites comes in the form of TAG. That's a time and attendance software. It's a biometric software. Only pre-qualified and competent people are allowed on our sites. They have to have their certification, they have to have their inductions. Using this information, we can then assess resources and man hours worked on site. We utilise our drone scans and our videos to record and communicate on the AConnect platform with all parts of our business. With our drone scans, we can input all our design drawings. This gives us the ability in pre-construction to coordinate the works better, to understand the site constraints, to overlay legal boundaries, and to facilitate a more streamlined process when we get to site. Utilising our drone technology with real-time kinematics and some ground control points, we can automatically fly pre-identified routes to ensure consistency across our projects. This information is then taken into Pix 4D BIM and it's correlated, essentially stitching all the photographs together to give us a 3D scan of the area. We can then take that 3D scan, export it to CAD and input that into our earthworks modelling software. This gives us the best opportunity to value engineer and de-risk our civil engineering projects at an early stage before we even go into a site. On most of our sites, we use robotic GPS excavators. These excavators are pre-programmed. They know where to dig, how deep to dig, and without prior approval, cannot go any further or any deeper. This gives us certainty around costs and variations. And that gives us a distinct advantage when we're doing monthly valuations and end-of-year accounts and negates any potential conflicts that may occur. Another benefit of using the drone scans is we have historical information. We can now measure, take areas, calculate volumes. Practical examples of that might be I can go back 3 months and I can determine how many blocks went on a substructure. I can see how much stone went under a road. This significantly de-risks our variations and our subcontractor management. By using our time and attendance software, We now have the information to compare the production rates, which we generated from the time-stamped drone images, to the resources that were put on by any particular subcontractor. This gives us a key insight into their potential margin and provides a more transparent and clearer route to procurement going forward. We use our drone scans to update our programs in real time. This provides the business with transparency to look across various projects and ensure that we are agile and we can adjust site production rates to meet the demand. This allows us to effectively manage our portfolio in a far more efficient way. We're encouraging technology to connect sites. I'm not aware of anybody that is taking this technology to be as advanced as we have it. We have huge ambitions in Glenveigh and technology is going to be absolutely key to that. In the coming years, I see a point where we can use augmented reality. People should be able to look around at a 3D model of their house and pick their house and walk the site. Why not? As I mentioned in the video, we currently have our drone surveys integrating with our modelling software to ensure that we incorporate the best value solution from the outset of a project. This one activity is having a profound effect on how we manage and plan our earthworks, the single largest risk item when it comes to suburban delivery. We've embraced technology. It helps us shape how we operate and grow our business, helps us communicate, manage and monitor our sites. We can now coordinate our portfolio and more accurately plan for the future. This, alongside a solid, sustainable supply chain, position us well for the ambitious but achievable growth and expansion that Stephen has outlined earlier. I'd like to thank you for your time, and now I'll hand you over to Fergus Boyle, who will talk to you about our delivery capabilities for our urban developments.
Housekeeping. Thank you, ladies and gentlemen. My name is Fergus Boyle. I'm Construction Director for the Urban Developments at Glenveigh. I have 25 years' experience in large-scale apartment construction, both in London and in Dublin. The following will give you some sense of the size, complexity of some of the projects I've been involved in. To start off with, Wapping Lane. Here I was Construction Director with Ballymoughal. It was the first residential project after the recession. We built 124 apartments over 2 buildings with a basement parking. This opened the gateway to Embassy Gardens, next door to the new American Embassy in Nine Elms. This project was funded by NAMA. Embassy Gardens was the single biggest construction site in London at its time, and at its peak we had 11 tower cranes, 1,000 operatives, plus a management staff of 78 people. We hand-built 3 million bricks to complete the commercial, retail, restaurant and leisure facilities, along with a Waitrose supermarket and a large underground car park. Lincoln Square, which is only three streets away from here, was an island site in central London where we delivered a very high-spec apartment development next door to the law courts and the universities. That was for Sean Mulryan. So here's what I'm doing now for Stephen Garvey. I am assembling a strong team in Glenveigh that is delivering at the moment. Here are some examples of what we're delivering at present. Herbert Hill in Dundrum. This 90-unit apartment scheme was completed in Q3 last year, including full fit-out with furniture and all-white goods. The scheme was sold to Realis Investments and handed over following a snagging process which was completed over a short period of 2 weeks, showing the quality of the product that we had achieved on that job. Marina Village Greystones. This 210-unit development constructed on public lands, and we are engaged and working closely with the local authority on this project. The first block of this coastal development was completed Q4 2019, and the balance of the project is due for completion at the end of this year. This project also has a large public park and coastal walkway. Adelaide Road in Bray, this 71-unit development, commenced in Q3 2019. The structure is now up to second floor. All packages and subcontractors are procured, and we are expected to complete this project in Q1 2021. Coming up now, here are some of our new projects which we're just starting. Eden in Cork. We are breaking ground on this 271-unit apartment complex in March. The plan is to build this, to build the Undercroft car park up to podium level in traditional concrete construction. Thereafter, we are considering the 2D building of the apartments themselves, which Peter alluded to earlier on in his presentation. Dublin Docklands. This multi-unit scheme with 2 hotels, office block and 1,150 apartments. This is very similar in scale and size to Embassy Gardens, which we referred to earlier on in my presentation. Enabling works has commenced on this project, and full construction will ramp up in Q2 this year. In addition to Glenveagh's procurement team and existing subcontractor base, it is my intention to bring expertise in from the UK. We are currently negotiating with formwork, bricklaying and drylining contractors, all of whom I've worked with previously and who have a wealth of experience and proven track record in their respective fields and are enthusiastic about the prospect of expanding their operations into Ireland. Castleknock in Dublin. This city centre site is located near the Phoenix Park, the largest enclosed public park in any city in Europe. This 190-unit scheme will start in 2021, and we've already started looking at the buildability of this project. Cork Docklands. This is the first development in the Cork Docklands. As you enter the city, this Glenveagh development will be the key landmark on the horizon. This high-rise gateway includes offices, commercial buildings and a hotel. 1,100 apartments will form part of this development. As I said, I am building my team, and delivering of these projects outlined above require a strong and committed senior management team. Brendan Corcoran has an established track record in delivering projects with Glenveagh and has recently been appointed as Senior Contracts Manager on the Bray and Greystones projects. Joining me from the UK are Kevin Delaney and Brendan Cohen. Kevin, who will be the Senior Contracts Manager on our Docklands project, has worked alongside me in Ballymore on Embassy Gardens project. Brendan Cohen also has considerable management experience in London apartments, has just completed 250 City Road with the Berkeley Group. Brendan will head up our Cork projects. My senior management team, with a wealth of experience and track record at home and abroad, gives Glenveagh a sizable advantage in establishing a reputation as a key player in the apartment building market in Ireland. The apartment market is a great opportunity for Glenveagh, and I am very excited to lead it for Stephen. I'd now like to introduce you to our CFO, Michael Rice. Thank you.
Try and find an uncontaminated glass of water. Good afternoon, everyone. Mine is the final presentation of the day, and I'll use it to bring together some of what the team have said, but also show you the financial impact of what they've said. Stephen has introduced his strategy for the business and the increased delivery targets. Conor has given us some economic data that has created the market to allow us to increase our delivery targets.
Wesley has emphasised the strong and well-located land bank that we currently have, but also the very attractive land market that we see in front of us. Peter, Tony and Fergus gave you an overview of the planning, design and construction departments and all the ongoing initiatives that we're introducing to benefit the business in the medium to long term. As I said, I'm going to spend about the next 20 minutes or so giving more detail on the financial impact and in particular the impact on the P&L, balance sheet and our net debt position, and ultimately what this means for return on capital employed. Just to act as a reminder, Stephen has already outlined our significantly increased output targets with 2,650 units between 2022 and 2024, culminating with an output target of 3,000 units in 2024. By that stage, we will have delivered nearly 12,000 units, which is effectively our current land bank. In line with our new business segments, the increased output targets have been split across suburban and urban. Approximately 3,000 units, or 30% of our units, will come from urban apartment schemes in the next 5 years, and given this significance, it's appropriate that a dedicated segment has been established, particularly when each of the segments now have quite an independent financial criteria. Let's start with the suburban segment, given that this has been our main focus since IPO. Our portfolio reflects the more affordable and deepest segment of the market due to average wage rates and our central bank's macroprudential rules. Our decision to focus on this segment has been supported by the market data and justified through our growth and surpassing our delivery targets in both full years of operations. As you can see on the right-hand side, 90% of our current suburban land bank is focused on the sub 325,000 market. Given the spread across the various price points, it makes sense that our average ASP is 270,000 on a spot basis. It is important to give greater context to this figure as it purely relates to the suburban segment. The urban portfolio, which will carry a much higher ASP given location and product type, and they need to be viewed together when assessing the overall revenue profile in the coming years. Our urban segment will have a very different revenue profile to that in the suburban segment, and our target is to forward fund our urban developments. Based on what we've seen in the market to date and some initial discussions with interested parties on our urban portfolio, we feel that this is an appropriate target. In very simple terms, a forward fund model will allow us to sell the land post-planning to our forward fund partner and recoup our land costs. Our partner will then finance the working capital requirements of the construction phase, giving us a very capital-light model from post-planning to completion of the project. The land revenue and any potential profits are recognised once the land transfers to the forward fund partner, and then revenue and profits are recognised throughout the construction phase based on stage of completion. This means that revenue, profits and cash will be received in advance of any completed units and delivers these returns a number of years earlier than some analysts have in their models. As you can see, the emergence of the urban model will create a divergence from the current ASP multiplied by units completed formula. It is important in the context of the right-hand side, but more particularly the delivery of the urban element of our increased delivery targets. Even though the majority of units will be completed in 22, 23 and 24, the revenue, profits and cash will be recognised as soon as the land is sold and construction begins. The revenue profile of these projects will be determined based on rental prices and yields in these urban locations, and the timing of this revenue will be spread across the land disposal and construction timelines. We acknowledge that this is a new way of thinking of Glenveagh revenue, and therefore further guidance will be required from us, and will provide this once more certainty on individual projects is available. This revenue and funding model will play a significant role in the enhanced capital structure of the business, particularly when you consider the number of urban units that we have outlined in our plan today. We have seen solid gross margin progression in our first full 2 years of operations, with 17% gross margin in 2018 and 18% gross margin in 2019. Our current spot gross margin across our entire portfolio is 18%, with no HPI and no CPI. We have strong visibility on continued margin progression over the coming years, but probably not at the original pace that was set out at IPO, 20% in 2020. It's worth noting, though, that this target was set in an environment of 5 to 7% HPI in the new market, in the new homes market, with double-digit growth in the overall market. Is 20% gross margin still achievable? Absolutely, but it will just take us a little bit longer than it was originally envisaged. We are confident of this continued margin progression due to three main factors: the attractive land that we can purchase in these locations, our ability to achieve better HPI than is in the market, and our ability to better control CPI. The first of the main factors, and you can see it on the right-hand side, and as Wesley outlined, is that the land market is very favourable and allows us to continually challenge our acquisition hurdles. For the first 14 months post-IPO, we acquired the majority of our current land with a minimum spot gross margin of 17%, but in reality, the average acquisition was around 18%. From 2019 onwards, we pushed the hurdle to 20%, and we've been acquiring land at this rate since, and we envisage that we can continue to buy our land at this minimum spot gross margin hurdle into the future. We will see a natural margin progression by simply introducing this newly acquired land into our active construction portfolio. The second main factor for continued margin progression is HPI and the initiatives that we're introducing to maintain and improve HPI. We saw 2.75% HPI across our portfolio between our autumn selling season 2019 and our autumn selling season 2018. Given current wage inflation and our continued focus on the more affordable end of the market, we would expect a similar trend to continue in the future, even with the current restrictive macro-prudential rules. As the business matures, we have started to look at HPI from different perspectives, and one of the new metrics that we're looking at is HPI per square foot. Peter has touched on how our design improvements and maximising the utilisation of our land can influence this. This slide provides an example from an existing housing scheme and how we were able to influence the densities and efficiencies and create greater revenue for that particular phase. We achieved 16 additional units. We had a 20% gain on the units per hectare. We were able to reduce the total square footage by 6% without impacting the attractiveness or the saleability of the home. And most importantly for me, we had a 12% gain in terms of the revenue in that phase. The third and final element of our gross margin progression is our ability to control CPI and the initiatives that can influence this. As we've hopefully demonstrated today, we continue to be innovative in how we look at our planning, design and construction methodologies, and our investment to date in these areas will see future margin progression. The full benefits from our planning design improvements will be seen in 2021 and 2022 because the initiatives that Peter and his team are working on now will only see the true benefit from those when they're active construction sites in those years. We have already started to see the benefits from our timber frame supply agreements through lower prices and guaranteed supply. You heard from John Keenan of KTF, one of our key timber frame suppliers, and I think the strength of that partnership is already quite visible. Later this year, we will open our disused quarry facility, which we purchased in 2018, to take inert material from our construction sites. The disposal of inert material has seen significant price increases in the last 2 years, and this facility allows us to better control those costs. You have seen the benefits that technology can bring to the construction department, and the video with drone footage, our tag time and attendance system, and our Aconex system being to the fore. But the rollout of technology is not simply focused on the construction department. We went live on a new procurement, commercial and financial reporting system in Q4 2019, with further technology being rolled out in 2020 in our sales and HR departments. The true benefit from this investment in technology will only really be seen when we're at scale and delivering 3,000 units per year. To give you a sense of where CPI is at the moment, overall we have seen 2 to 2.5% CPI from our current tendering, with inflation really coming on the labour side. Materials have been relatively flat for the last 12 months due to the good work that our procurement department, but given the low unemployment numbers, we have seen some increases in labour, both direct and from subcontractors. Recently, we have seen new wage rates introduced in our sector, with a further 3% increase to come in October of this year. These increases are already in our forecasts, but they point towards the greater need for off-site construction and to try and reduce the hours on site and our reliance on certain trades. Our investment in the business is not only in technology, but possibly more importantly, it's in our people as well. We continue to invest in the business with the medium to long-term goals in mind, and this is applicable to our investment in our skills team that we have. We have built a business of over 330 people, but most importantly, 220 of those are on our sites with related costs sitting in gross margin. A further 80 people whose costs sit in overhead are construction focused and include health and safety, planning and design, quantity surveyors and our central procurement department. Overall, 90% of our employees are construction focused, regardless of where their costs sit. The recruitment of this skilled team has allowed us to ramp up at the current rate and gives us the confidence to continue to grow on this growth trajectory. Glenveagh has already established itself as a very attractive employer, not only in the Irish construction sector, but also in the overall employment market. We made a conscious decision early post-IPO that to grow the business quickly and effectively, we needed to build the team and the systems early. We knew that if we didn't put the infrastructure and systems in place when we were operating on 15 to 20 sites, we didn't have any chance to implement these when we were on 40 plus sites. We have invested in the people in all three segments, with particular focus on the partnerships model, which isn't revenue generating yet. As you've seen from Peter, we have invested heavily in the planning, design and manufacturing capabilities of the group. We have established a best-in-class health and safety department, and we continue to invest in that. We continue to invest in our new site openings to facilitate the ramp-up and the increased delivery targets that we set out today. We have invested in our sales team to build ourselves as a trusted brand in the market that is customer-focused now and will continue to be into the future. We've invested in a strong PLC and corporate team to ensure strong corporate governance, which John has already mentioned, and reporting frameworks during the significant ramp-up stage. With this investment already in place, our ongoing recruitment and spend is now site-specific, and therefore our overhead as a percentage of revenue will increase significantly in the coming years, with a target of less than 4.5% over the medium term. We'll now spend a couple of slides working through the balance sheet and how we plan to enhance the capital profile of the business. As Wesley has demonstrated, we now have a strong land bank focused on the starter home market. It's this strong land bank that has given us a very solid base to work from. But we need to continue to invest in our land bank to ensure that we have a balanced land bank in terms of geographies, site size and product mix for the medium to long term. It is important to us that even with this continued investment in land, the refinement and evolution of our land bank will generate significant cash, with over €100 million coming back to the business by the end of 2021. Notably, our assumptions on the evolution of our land bank does not include any investment in strategic, structured or partnership land deals. As Wesley has outlined, these are key to the business strategy going forward, and their reduced capital requirement will have a material impact on the capital profile of our business. The majority of our multi-year sites delivering units for the next 4 to 5 years are already in place, with the initial setup already done. The sites to acquire over the coming years will be focused towards smaller, incremental sites, and in fairness, you have seen us do this over the last 6 to 9 months. Our continued investment ensures that we have the correct and balanced land bank across geographies, site size and product mix, but is also evident through the new sites on our path to opening 41 by 2024. Continuing to acquire sites also ensures that we have the appropriate land bank for our unit deliveries post-2024, and this makes sense when you consider that we'll have delivered 12,000 units at that point, which is effectively our current land bank. Our continued ramp up to 41 sites is in the context of us having already opened 20 sites, an average of 10 a year. This proven track record, along with having the skilled management team and the infrastructure already in place, gives us that confidence that we can certainly achieve our goals that we've set out. Our goal is to become a more efficient user of capital, and this is not limited to our land capital per unit, as Stephen has shown you, but also our work in progress per unit. We will reduce our WIP per unit over the coming years through a combination of better construction efficiency in the suburban segment, but also through the introduction of our forward fund model in our urban segment. The continued ramp up in the business and the tripling of construction output will need a significant investment in WIP over the coming years, with incremental investment to be 240 million in the next 3 years. This level of investment does not continue in the longer term and levels off in 2023 and 2024, as you can see. This flatter profile of WIP investment is key to the creation of excess cash in the business. My final slide acts as a summary of the financial initiatives that we are implementing and what that ultimately means for shareholder returns. Our priorities are and remain to be increasing our unit output to give greater revenue and earlier revenue in the case of our urban segment, improving our operating margin through scale and continued efficiencies, reducing our euro investment in land, which we have seen already gives over 100 million back to the business in the next 2 years, investing in our construction activity through WIP funding, given the very strong visibility and attractive returns we see from this investment, forward funding our urban portfolio, which reduces our WIP requirements, and ultimately continuing to enhance our return on capital for the business. These priorities need to be considered in the context of our funding model and our appetite for debt. Our preference, given our sector and our relative infancy as a business, is to limit the financial risk that we put on our business, and therefore we want to maintain a prudent leverage policy, particularly in the near term. Capital returns to shareholders is a very important part of our strategy, but given the very favourable market dynamics, our priority remains to grow the business, but not at any costs. As you can see, cash will be available to the business from each of the potential forward fund deals and the levelling off of our WIP investment, but we feel it is just too early to give a specific date on when we will return cash to shareholders. But I can assure you, once we have excess cash available, we will return it to shareholders. It is important for us that any capital returns programme is timely, meaningful and sustainable. They're fancy words, but what do they actually mean? We don't want a significant time lag between announcing and returning cash to shareholders. The quantum should be material and meaningful and have a significant impact with shareholders. Any capital returns policy and programme should be long-term in nature, with strong visibility on future and subsequent returns. Our goal remains to create a long-term and capital-efficient business that will be the leading home builder in Ireland. We believe that focusing on these priorities, having the discipline to maintain an appropriate funding model, and demonstrating a sustainable capital returns programme will give us that business. Thank you very much. We're going to do a Q&A panel now, but if there's any specific questions in relation to my slides, I'm happy to take them now before we go into the panel session.
Just on slide 68 with the percentage completion for urban projects.
Sorry, go back now.
Yeah,
Yes.
so I think this represents the accounting revenue, but what is the cash? You made reference to receiving cash,
Yeah.
but aside from the land revenue, which I assume is
Sure.
cash, how does the cash receipt work?
Yeah, so the way we've looked at it, and obviously this is from initial discussions we've had, we'll sell the land up front. Title will pass to the forward fund partner, and as you said, cash and revenue will be recognised on a clean land sale. We'll then effectively enter into a development agreement with the forward fund partner. We'll construct on their behalf. There'll be timely, probably monthly independent surveys done on our work, and effectively we will get paid for that continued work. So the cash revenue and profits are effectively recognised throughout the construction phase. So going back to one of my comments, it's probably incumbent on us to look at it on a project by project basis and give you guys further guidance when we're very close to either signing or starting a construction phase, to say to you, it's a 36-month build, therefore you're going to recognise your revenue and profits realistically evenly over that 36 months. So, reflecting the completed units in the dark blue on the right-hand side, you're seeing the divergence between when the completed units happen and actually the revenue and profits. So revenue and profits will come in advance of completed units.
But just so I'm clear, revenue and profits, I get that, but what about the cash?
Yeah, we'll get paid. We'll get paid for the work throughout the construction
including
phase.
Profits?
Yes.
Okay, because typically in percentage completion,
so
the actual cash is pushed out further.
No, we'll get paid for the work we do. We'll be like a main contractor. Once it's certified, we'll get paid for it.
Okay.
Go this way, make it easy.
On that point as well, Michael, just to what extent is one of those deals on the forward funding two separate transactions, where maybe look at it as the land transaction separately and then the contracting work on top of that? I suppose what I'm trying to get at is, could there potentially be very different margins on either of those separate transactions, or are you going to see more of a blend across a whole site?
No, I think you'll see a blend, and that's probably, it's up to us in terms of negotiation. Obviously, I'm stating the obvious, but the land and the end building will go to the same party, so it'll all form part of the negotiation. So it's probably incumbent on us to make sure that the overall margin that we see on the development is reflective in both the land sale and the development sale. I suppose it's not in our interest to create any lumpiness in terms of extreme examples, but a 25% margin on the land and a 10% margin on the construction phase. So, again, going back to the point in terms of project by project, it'll require us to communicate to the overall market in terms of what individual deals look like. But I don't think you're not going to see any large difference between the land and the construction element.
Thank you, Michael. Colin Lauder and Goodbody. I suppose a follow-on question to my two colleagues there, thinking about sort of the timeline, the cash flows from both the forward fund and the forward purchase agreements, and then overlaying that with the split across the portfolio. So we've looked at, say, the last 12 months. You've seen schemes both in suburban apartment design, which were more focused, perhaps first-time buyer, or not first-time buyers, but owner-occupiers when they were designed, like Herbert Hill, and then the more individual housing units with Semple Woods and Taylor Hill, which were again designed from a perspective of an owner-occupier ending up with an institutional investor. How much optionality do you build into those sort of conversations when you're thinking about a design stage? So when we look at more on the suburban apartment style schemes, and we look at the split, and maybe this is one for Peter later on in terms of the design split, and I noticed you have comments about the standardisation of design. But how early does the conversation happen when you're thinking, well, that scheme, we prefer to focus more on a PRS side, therefore we'd look at the design route there, or do you want to keep those options open in case there is perhaps a softening in PRS?
Yeah, and I think you've touched on the point earlier, in the likes of what we've done to date in Herbert Hill. That was originally designed as a build-to-sell development. PRS moved significantly during the construction phase, and it ultimately became a PRS deal. I think with the creation of the urban segment, and we have moved certain assets from what would have been the old homes model or the old home sector into the urban. The aim for the urban segment is to forward fund and bring in that funding partner on all of that. So I think it's certainly, you know, part of our thought process as we're looking at planning to think, and let's be honest, we know a lot of what the PRS buyers are looking for. So part of the planning discussion and the design is around what the PRS guys are looking for. So I suppose we now have the advantage of knowing that the PRS market is there in terms of planning. It's probably not something we had in the past because the PRS market hadn't progressed. So, you know, probably to answer your point, your question more directly, you know, we can start making those decisions pre-planning in terms of what a PRS buyer is going to want.
Okay, thanks, Michael.
Behind you there.
Yeah, I just wanted to follow up on this particular point. If I was one of the guys that was interested in forward funding this with you, is the reason why I'd be doing that just for certainty of supply? In other words, the market is so tight out in Dublin, I assume, for most of these. It's so tight that that is why I'd be doing it, to ensure I get certainty of delivery.
Yeah. Yeah, to answer your question, it is. Conor and Stephen both touched on it. You know, the number of PRS buyers that are coming into the Dublin market, you know, significantly outstrips the supply and more importantly, the number of people or the number of companies that can actually deliver that product. So absolutely, it's working to our advantage that they're so keen to get into the Dublin market that they're willing to do these forward fund deals. You know, we've seen the compression of yields over the last 12 to 18 months. That again, you know, demonstrates the level of interest that there is in the PRS Dublin market. So, as Conor said, it's certainly an asset class and a delivery platform that's here to stay. And we like to think we've demonstrated our adaptability to that change in the market by creating this urban segment, which, you know, will be solely focused on that institutional buyer.
And can I just follow up? In terms of the 40 sites you might be working on in, I think it was 2023, I think it was, how many sites will be operating on this kind of model, do you expect?
So I suppose over that 5-year delivery period, there's 3,000 units or 30% of the deliveries in that urban model. Our aim, as we stand here today, is to try and forward fund all of that urban segment. So that 30% we will try and forward fund. So, you know, it can be a significant part of the business, and going back to one of my points in terms of enhancing that capital return, it's going to play a significant part of that. But as I said, it's certainly our aim to try and forward fund as much of that urban development or urban segment as possible.
Thank you.
Just one point we would make about it, because it's not just about the capital and getting the capital to work that's important for the institutional investors. It's also the quality and the capability of being able to deliver the product. So a lot of institutions want to get their money working fast, but the problem for them is, who do they team up with? You're living in a market that has no competition. So the key for them is actually, can I partner up with someone that can actually deliver exactly what I want? And just an experience to talk about Herbert Hill, and the one thing that stuck out to about us was, yes, location was critical, but also the build, the programme, the collateral warranties, blue chip backing kind of, it all came to the fore. What we could offer, what others can't, you know, guarantees from the PLC. If you're a small developer with and I use this perfect example, let's say you're building out of an SPV and the balance sheet of that SPV is €300. What have you to chase? If you're an institutional investor, how do you go to your investment committee and make the case, I'm partnering up with the right people to deliver the right product, but I've only got €300 to chase here? That's an example of the difference of what we're offering versus what the rest of the market can offer. And there's very few that can do that. Sorry, I just said I'd follow up because I just wanted to...
You started over there and
yes,
you ended up
over here. Can I maybe just clarify? This revenue example here is for forward funding. When we're talking an institutional buyer, though, on the suburban, are you talking about that you think you can get forward funding on the suburban? Or are you talking that you're going to do forward sales? Because they're two very different profiles in terms of the capital
I think
and cash flow.
on the suburban side, and you've seen it to date with the IRES deal, they're more akin to a forward purchase. particularly in the scale and the size that institutions are buying. We did 118 units with IRES. We're building that phase anyway. So in terms of working capital, it's not that intensive. So we're happy to take on the suburban element. I think if you were to do a wider deal in terms of the suburban segment and in terms of a 300, 400, 500 unit deal, I think that's when you'd start looking at phase payments. But at the moment, the institutions are looking at that 100 to 150, and that's certainly something that's just on a forward purchase basis, so doesn't fit into that model.
I have a few more questions, but they're actually directed to Peter and Fergus. Shall I wait or shall I?
Oh, yeah.
They'll all be up on stage in 2 minutes.
Your voice is loud enough, Jack. You don't need the microphone.
I'll speak quietly. Thank you for everything. Just on slide 73, I think it was. The phrase in the top right, the increased investment, is that a forward-looking or backward-looking statement?
I suppose it's if you look at what we've created to date, it's really a backwards-looking statement. We've invested in a lot of the infrastructure and the technology already. We've probably talked probably over the last 12, 18 months, we've talked a lot about our overhead and realistically probably defending our overhead. And I think what today hopefully demonstrates is where we've been spending that money. So, we talk about reducing our overhead as a percentage of revenue because we now have that infrastructure, we now have that team in place, probably realistically to hit the delivery targets that we've put out today. The incremental spend in terms of euro is very little year on year, and that percentage of revenue comes down significantly. So, when you look at our health and safety, our innovative thinking around planning, design, our construction, our technology, our new systems, all of that is with the mindset of 2023, 2024 in mind. And I mentioned earlier that if we didn't do this when we're active on 15 sites, let's be honest, we haven't a hope in hell of doing it when we're on 40 or 45 sites. So we've deliberately invested now to allow us to grow that business. So hopefully the conversation around the quantum of overhead is going to drop away now when we can clearly show where it's been spent and what it's been spent on.
Thank you.
Anybody else? Yeah. Back down in front then. Give the mic a bit of it.
Hi, sorry. The 240 million of WIP that needs to be funded over the next 3 years.
Yeah.
Can all that be done organically, or would you need equity, or given your aversion to debt, how do you intend to fund that? I know forward sales will be a big part of that.
Yeah,
and then
I wouldn't say we have an aversion to debt. I suppose we just have given the sector, given the history, particularly in Ireland of the sector, we've just come at it with a prudent view of the level of debt that we want to carry at any point in time. But we certainly don't need to go back to the markets and raise more equity. That WIP investment will be funded through a combination of our debt facility. So we've a 250 million debt facility with AIB, Barclays, and HSBC. So, as you point out, some of that is going to be forward funded. So, a combination of the cash generated from the business and a sensible use of our debt will finance that investment in WIP.
Right to that lady there. There's one more question down the front.
Todd?
Yeah.
I think you're close enough now.
Yeah, so when I look at the next 5 years, looks
Yep.
like you're roughly budgeting to buy 80 million euro per year of new land. Looks like you're talking about a 20% margin. You're focusing on new land purchase, but you've said you're struggling to get past 18, and we have to wait a bit longer for that. So help me understand how you can be buying land, targeting a 20% margin, land price that has appreciated, and on the land that you own now at cheaper prices, you're not breaking 18%. So help us understand that, call it 400 million you're going to spend on land in the next 5 years at a margin you've not been able to achieve on lower priced land you own today.
There's a fair bit in that. So just to, I suppose, unwind a couple of the things you've said. We certainly don't think we're struggling to get past the 18%. We delivered 17 in our first year. We delivered 18 in our second year. We'd be confident to move that margin forward. It's just not going to be the 20% margin that we had set out at IPO. And I talked about the HPI environment that was there at the time we set out that original hurdle. We're buying land at 20% margin now, so naturally, and sorry to skip through, but I suppose what we have in our portfolio now is a mix of that 17 and 18% land that we bought. There were the spot margins that we bought it at. Granted, there's been some HPI in the interim, but I think the more of that land, the more of that 20% land that we bring into our portfolio, our active construction portfolio, and obviously if we continue to buy land, and you can see from one of the slides that we will continue to buy land at 20% margin, that just naturally has that incremental improvement to margin. So
I just don't understand how, if the land you own now is at a cheaper price because you bought it 2 or 3 years ago, land now is a more expensive price. How are you getting a 20% margin if you can't get that now?
It's not more expensive is the point. So we would say the land market has probably, and Wesley can speak to it better than I can in the Q&A, but the land market has been pretty flat probably for 12, 18 months. So, we're buying land now as well as we were post-IPO. So, as I said, we're buying land better, we're challenging those hurdles, and part of the reason we can challenge those hurdles is because we have a very stable land bank. We don't need to increase it anymore. So we can be very picky, and Wesley touched on the point of the amount of land that we actually look at and turn down. So we can be very picky, and we talked about incremental and smaller sites. That's the type of land we need to buy now. So we can be very selective on when we buy that land and how we buy that land. So having that strong base to work for has allowed us to be a little bit pickier and a little bit choosier, if that's even a word, on the land that we buy. I suppose the other point, and I made it to two of our shareholders at the break. We're not looking at this from the perspective of we suddenly stop in 2024. We need to think about where we are in 25, 26, 27, and the land that we need to buy now. There's no point us, stop buying land, deliver 12,000 units over the period, and then come to the end of 2024 and realise we've no land to build on in 25, 26, 27. So, a portion of what you're seeing here, particularly in 22, 23, 24, is actually looking out into 25, 26, 27. Peter has talked a lot about being able to design it as we can. So, to be able to put our design into a site, we need the time to design it the way we want and the most efficient way. If we buy land in 2024 that's going to deliver in 2025, chances are it already has planning. It doesn't have the planning that we want. It's not our product type. So you end up building 4-bedroom houses that isn't our market. So we need to continue to invest in land. But I think the important piece here is, yes, we're continuing to invest in land for the longer term, and our units might stay at 13, 14,000. But that euro investment is coming down significantly. Like reducing our land bank or reducing our euro investment by 100 million in the next 2 years is a significant reduction. And you can see that reduction continues. And part of that is, going back to my original point, part of that is recycling the land that we had at IPO, recycling that out and replacing it with cheaper land. Recycling out sites that were 100,000 a unit at IPO, we're now buying land at 40,000 a unit. So that evolution of the land bank just naturally creates that cash and brings it back in. So yes, we're continuing to invest in land, but we're not net spenders on land. We're bringing cash back into the business at the same time as buying land with the long term in mind.
What HPI assumptions are you making when you buy land?
No HPI assumptions. So we build it and sell it today. So no HPI, no CPI. So when we talk about spot, it's genuinely spot. No HPI, no CPI. So that 20%, build it and sell it today.
Has
How do we think about this land spend trajectory in the context of a 5-year land bank that you're targeting? Like, is the 5-year target going to be reached in 2023 or 2028? Like, how do we think about that?
I suppose firstly just to make the point that this is, and you know, Wesley had it in his category 1, category 2, this is probably the most conservative that we can be in terms of how we continue to buy our land. If we can bring in strategic and structured land, but particularly if we can bring in partnerships land, that will allow us to actually decrease these numbers or decrease the investment further. So yes, it's, you know, we're talking about a 4.5 to 5 year land bank now, which is effectively, you know, as I said, 13 to 14,000 units. But if the partnerships business came in and we were able to get, you know, 400 or 500 units out of that with a clear line of sight, because these schemes or these developments are going to be, you know, 4, 5, 6 years in length. So that gives you good visibility and good certainty around outputs. So if we had that in the model, you could certainly run the land bank down to circa maybe 10, 11,000. So not wanting to avoid your question, I'm just saying there's a lot of evolution in terms of strategic and structured land to happen.
I say let's just take it in parts. I'm just trying to understand by 2024, is this assuming you can be 5 years by 2024? And then you actually are starting to answer my second question, which was how does the strategic and structured land partnerships then impact that 5-year number, right, at the 3,000 target?
So this effectively reflects bringing the 3,000 units that you see. This will reflect a 13 to 14,000. So that reflects your 4.5 to 5 year land bank. Your second question, and I probably answered it already, but you know, absolutely, if we can be more creative and innovative in how we buy land, there's risk to the upside here.
Sorry, the election was coming up. How does that change your thinking if there was a Fianna Fáil Sinn Féin coalition? Seems to be possible.
That'll change everyone's thinking.
If it's all right, I might.
How does that dramatically change your?
It's all right. We might hold the general question just in the general plan, just for we get the wider panel on stage. Is there anything more specifically on Michael's section that anyone wants to raise before we move on?
I'm happy to get into politics, Conor.
No, that's very.
Sorry, just finishing up on margins. Homes, living margins, we used to talk about slightly different margins. And I'm conscious with this greater focus coming through in terms of forward funding, should we assume those forward funding completions are done at a marginally lower margin than what would be the suburban, I guess, if you now phrase it that way?
Not necessarily. I suppose we would have talked previous around the 3 segments and homes at the time having the highest gross margin, then the step down in terms of living, and then the step down to partnerships again. I think given the PRS demand and what we're seeing, that urban margin is now moving closer to the suburban margin. So I don't think you need to assume that we're talking 300 basis points or anything like that. I think, you know, it'll be thereabouts in terms of the suburban margin.
May I follow up question on that? Just think about the margin. I hope I don't put you in an awkward spot talking about an individual deal, but maybe just to go back to the sort of Taylor Hill deal. I know Knight Frank yesterday announced their prices for your next few phases, so between 270 and 350 for a house, and then obviously looking at, say, the IRES deal, which is about 320, 325, including VAT. How are you looking at the pricing spreads between these? Are you able to comment on you think these were done at a premium to what you had sort of considered ASPs for those units?
They're not done at a premium, but they're not done at a discount. There's effectively, it's, you know, the way we would view it is you're getting the same revenue as you would if you were selling to the private buyer. The benefit that we have is it gives us certainty in terms of volume and in terms of numbers. What it also allows us to do, and we would have always talked about, the private market will do 50 to 70 units per site per year. What the PRS market does allow us to do is actually ramp up that site slightly. So the 2 sites that you mentioned, you know, we would have done circa 100 units in each of those sites. We're still maintaining that 50 to 70 on the private market, but that PRS is giving us, you know, better return on capital because we can run the site quicker. So it's not really, you know, it's not really a revenue play. It's a return on capital allowing us to run the sites a little bit quicker play.
If I can start with Fergus, you're looking very relaxed up there, so I'm going to start with you. A couple of questions. One, in terms of labour, you talked about bringing labour across from the UK to Ireland.
Yes.
There isn't necessarily an oversupply of labour in the UK, so I'm quite surprised at that movement. How will that impact things like your costs?
It's specialist contractors that have capacity at the moment, that have people available, and we're looking at them to bring them in to augment and help us get moving with our large projects. It's not that we're, yeah.
Okay. Second of all, in terms of question for Fergus, if I look at the urban delivery, 2024 actually takes a step down. Now, I appreciate Docklands is a large part of what's within there, but is there any reason why you really should have that step down in 2024, apart from what your land guys are giving to you? Is there any reason why urbans should naturally drop off?
It's more just project specific, Lance. That's more what it is.
Okay. And then Peter, and the reason I picked Peter next is that you're not going to like the questions. You talked about releasing tomorrow. You talked about the first release tomorrow of the sort of new range, I'm going to take it as. Yep. Can you help us understand the movement you're talking about in terms of suburban versus urban on those suburban sites is really quite marked. How are you increasing that density? Are you making units smaller? Are you putting more per site? Are you building higher? Are we going 2.5 stories? What are you doing? Because obviously the question is, how is that going to impact the saleability?
Yeah, so the approach is very much consumer orientated, would you believe? And if you look at Ireland in general, the house type that's selling quite a bit, is that the house type that the consumer wants, or is it a product of affordability and what can be built based on compliance with planning regulations? What we're doing is just looking at the ground on site and looking at those parts of the site that aren't working hard enough for the business. And we're looking at bringing ground into play in terms of housing units that's not necessarily encroaching on public open space, but it's about being clever and creative on our approach to private open space and clever on our approach to housing layout. And it's not going into smaller units as such, and it's not going into multi-level units as such. So I'm not going to give the game away because I think this is something unique. I think it's something unique to Glenveagh. And I suppose what we've done is we've challenged design principles, just design principles, outside of the norm. And I think that's something that hasn't maybe been done in the industry before.
Corner turners and less gardens?
Say again?
Corner turners and less gardens?
No.
No, I think maybe to clarify Guinness's question, with your new proposal, would you envisage more apartments or less apartments, or more houses or less houses?
I've already addressed it in the presentation, but specifically, we're not compromising private open space. Was that the question?
No, I suppose it's going to density. Because there's the urbanisation of some of our suburban schemes, there's a requirement at present to build an element of apartments on those schemes. I suppose what I took from your presentation was that you weren't proposing to put more apartments, you were proposing to do a more efficient housing design to allow for more housing and lower density on that site. So you're actually providing a product that the customer wants.
Yeah, that's the whole, I suppose, the drive is the consumer requirement, rather than the consumer affording a product as a product, again to use the word, of compliance with planning regulations. So we would be maximising our suburban offering and minimising that urban apartment type offering in the suburban location.
Okay, I'll follow up on that one after. And then the off-site manufacture, building your own facilities costs money, whether or not you're building your own brick facility, your own timber frame facility, or whether or not you're building a roof tile facility. Is that in the guidance in terms of the cash usage, if we're going to see you go down that route of more off-site?
No, I suppose in the short term, it's just strong partnerships. It's not it's not a significant investment. It's not in the cash usage that we set out today. But as Peter mentioned and Stephen mentioned as well, it's certainly a direction of travel. As we if we ever look to integrate the supply chain and own some of these factories or manufacturing facilities, we'll certainly come out, because we appreciate it's a slight divergence from our main skill set, but it's not in the current numbers to run a factory or anything like that.
And I think a couple of key things just to point out is that if you want to maximise the efficiencies in the business, you always go after the high value items. So you go after the items that cost you the most and see can you extract the value out. Like ambition of building roof tiles and brick is pretty cheap. There's no need of doing it. It's maybe just a supply constraint. But the likes of those items are not required in our country because there's a good supply chain. It's really you're chasing the high value. How can you find the efficiency in the high value? And go back to what Michael is saying. You know, the partnership agreement with the likes of Keenan Timber Frames has offered us control of our own supply, quality, assurances, etc., etc. And it's having that efficiency. It's working with them, as Peter outlined. I think that's really bringing the supplier with us on that journey of exactly what we want to do. So,
thanks. As you've said yourselves, your volume targets are quite ambitious, although achievable. And just looking at page 75, there are 3 sites you're planning to open next year, and then 8 sites I think you're planning to open the year after that that you haven't acquired yet.
Yes.
So if the land market changes and you don't get the 20% gross margin presented to you, is the idea that you would cut back on the volumes and prioritise margin, or would you go for the volume because that's what you've laid out and that would just come at a slightly lower margin?
Yeah, I think one thing we've learned as a business is, and maybe Michael walked you through the margin profile of the business is, are you better off extract from a site at 18% versus trying to hang on and wait for 20%? So the theory in the business would be keep the machine moving as much as possible. But I would have no concerns about the land market and Wesley can go through it in more detail. The land market has really stabilised in our country and it's driven on a few fronts. I talked about the smaller guy falling to the side, but also the government realised that they don't want to create the same problem that happened before, where the land got constrained coming into the system. And the likes of the introduction of the vacant site levy goes back to our thesis. If you've introduced a vacant site levy, again, we don't want to bring politics into it, but one of the leading parties have said that they'll bring the vacant site levy up to 14%. Now, if you're a landholder and you don't have the machine to deliver houses and you don't have the vehicle and you don't have the finance, your only exit is partnering with someone like us. So that's where we really do see the opportunity. All the incentives are, and if you think about it this way, and I always make this point to a couple of people. I don't know, the guys that show me a site in a certain town and you could say, this is the best road in this town and best trees and best people, etc., etc. And we buy it for 70,000 a site. And they go down the road and they go to the other side of the street and they say, we can buy this for 40,000. I would always go for the 40,000 because in one sense our market is controlled. The macroprudential rules have set the rules of what people can buy. So they can never reach that 70. So in that sense we have a very fluid land market going forward, which means it isn't about the land as much. It's more about being efficient, being able to build the product. That's the key to the success, we think.
Just a few more from me as well, guys, if that's all right. Glad you brought up the vacant site levy, Stephen. That's what my first question was going to be on. I mean, when we look at the slide that Michael was talking about in terms of the change in spot margins going from 18 to 20, to what extent do you think the vacant site levy may have played into that? And extrapolating your comments there, could there be the potential to push hurdle rates on again at some point in time if that vacant site levy really begins to bite? I also then just wanted to ask on PRS sites. Obviously, we're saying that the margins have probably moved on the sites that you actually already own. The implication would be that the land market's probably moved on quite a bit on those sites as well. So when I think about you replenishing your urban land bank, or that part of the land bank, are the hurdle rates as attractive on the PRS side of the land market as it is in the suburban side?
Yeah, I'll deal with the latter one first. I suppose on the urban sites, if we were to replicate the margins we expected I'd say when we purchased them, yes, that's achievable. Obviously, through yield compression and rent rises, obviously that returns have grown. I think there's a couple of things that will be at play, and it goes back to the point Wesley was making in his presentation. Is there are some people who have acquired urban sites who just don't have the capability of delivering them. And the biggest thing that will test that deliverability will be when they try to talk to the institution, and the institution will demand X of them. So yes, it's probably the most difficult space to replenish those sites, but we have a long runway in front of us, so we're not overly concerned. Like you look at the Docklands, it's 11 to 1,200 units. You look at the Cork Docklands, 11 to 1,200 units, and we have various sites. So we're not worried about that anytime soon. And obviously it'll be an evolving market. Again, and you would have seen it on one of Wesley's slides, and one of the key sites is, you look at Dundrum Mental Hospital. This is now controlled by the Land Development Agency, and the Land Development Agency has been set up about probably 18 months at this stage, and is obviously working its way through legislation. And the whole idea of the Land Development Agency, it's tasked with three main tasks. Take all the semi-state land in its control, and then dispose of that land on an annualised basis, delivering it into the market around 7,500 units. But take that, just that hospital site is 38 acres, has the potential for 2,500 units. Now, you want to be a fairly substantial machine to go in on that, but that's an ideal one for the likes of us to partner up. So you could see the evolution of urban sites coming from the likes of the Land Development Agency and also the local authorities. So at this moment in time, we wouldn't be concerned. On the suburban sites, on where we see, the vacant site levy has certainly had some impact. It has focused people's minds. I certainly think, you know, if the mood music is correct in the elections, people will be more focused on it. Margin progression is where we want to go. As Michael said, 18% today is not our ambition for the business. Getting to 20%, it might be a little longer, but we intend to get there. Is 20% our ambition? No, it's not. And I suppose one day I was out with an investor and I made a point, and I went to make sure my facts were correct. In 2014, Persimmon, and I think this is correct, were 18%. Obviously, the market dynamics changed that to 32%. Barrett's were 14%. As a business, what we really want to achieve is, over a period of time, as we scale the machine and as we grow the business, we see margin progression. And obviously, if we can do that better and are more efficient with our capital, that delivers for everyone in the business.
And just maybe to allay your fears on the urban question, if you're to look at Michael's site opening bridge that he took you through, the majority of those sites that aren't owned sit on the suburban side. So effectively the urban pipeline out to 2024 is practically full from a land perspective.
I think just one thing to add, I think on those urban sites, like, and we've alluded, Stephen mentioned it earlier, but just to stress it, like the institutional buyer wants an institutional covenant as well in terms of delivery, and that's what's going to generate these sites. I believe those sites will come, there's no doubt about it.
Yep. Thanks, guys. And maybe one final one then, just again on the urban side. You've confirmed today that there's a fair bit of non-residential delivery to be completed on both the North Docks and in Cork. Is it your intention that Glenveigh deliver that non-residential portion of those sites, or could that potentially trade away?
It's not a major concern. Obviously, the likes of hotels are specialist skill set. Probably that skill set we bring from external resources. They're not the majority of the project, and it's probably more bolt-on. They do add incremental value, but I suppose our main focus will remain on the residential element. Our knitting is in building homes.
Yeah, just got another one on the margin outlook, if possible. If you take that 20% at spot, kind of zero HPI, CPI, if you think HPI is broadly capped to wage growth, given the macro potential rules, and you think construction wages probably grow ahead of overall wages, given the demographic trends that you guys have alluded to, you can tell me whether that's right or wrong. What confidence do you have of holding on to those margins, and what do you have kind of up the locker to, or levers do you have to pull on the construction side to ensure that you can hit those targets?
Yeah, I think, to answer your first piece on HPI, I think it would make perfect sense that if the macro potential rules are at a certain level, and as Connor's slide, one of Connor's slides shows, everyone's kind of pushing that ceiling in terms of the 3.5 times. I think it then just makes sense that it grows with overall wage growth, and Stephen has probably been saying that for the last probably 9-12 months, that that would make sense. So let's take it that the HPI is going to move at 3.5 times. On the cost side, as I said, we're kind of seeing between 2-2.5% at the moment. A lot of the initiatives that we're rolling out There, you'll only see it really in the margin in terms of 21, 22. So I think if you're taking 20% spot, I think you can see margin progression. You can certainly see margin progression. I think the big piece on margin is going to be the evolution in terms of the sites that are delivering those units. So, our IPO sites and working through those, and we've been very honest and open to say they're the most expensive sites that we have in our portfolio. So, those churning out what we were buying, pretty quick post-IPO in terms of 17 to 18%, that churning out as well. So it makes sense again that, more of the 20% spot land that's coming into our active construction with a little bit of HPI and that divergence between HPI and CPI, allows that continued margin progression. So, I think hopefully what you've seen from the guys is, we're not just trying to accept what the CPI is in the market. If CPI is running, above what wage growth is running at, I think we have the skills internally, we have the initiatives internally to probably run at about 50% what the external market is at. So if they're at 4, we'll be at 2. If there's a 6, we'll be at 3. If they're at 2, we'll be at 1. So I think we've shown that we're not just willing to accept what's the norm in the market. So we'll continue to push that CPI down. We'll continue to try and be innovative in terms of how we can achieve HPI, and that divergence between the two will continue that margin progression. So, I don't think there should be any concerns that there's suddenly a ceiling in terms of where our gross margin can get to.
Thanks.
Hi guys. It's probably a question for Steve and maybe Fergus as well, but obviously the Forward Fund is the model of choice for the urban projects, but obviously in North Wall you're looking to develop it organically or internally. It's obviously a flagship project for the North Docklands. It's a huge project for Glenveigh. Just maybe give us an idea of the scale of the opportunity here and why you decided to go down this route versus the Forward Fund.
Yeah, I suppose there's been a couple of things. Obviously, there's been an evolution in the PRS market in Ireland. A lot of institutions have come to invest in Ireland. They see the opportunity. And obviously, I spoke earlier about, to a certain degree, they've followed the likes of Google and others into the market. I think the big thing that sticks out to us is, and we see this is, and Wesley made the point earlier, is that, anyone can buy a site, but actually the key to the site is actually having the capability to deliver it. And we see that as a to a certain degree, having that skill set in the business will offer what others can't. Again, Fergus, why we targeted Fergus to come into our business is just you've seen his experience. The likes of Embassy Garden probably replicates to a certain degree what we're going to be doing on the docks, a project of that scale. But we already had the skill set to a certain degree in the team in the sense of delivering Herbert Hill. We commenced Herbert Hill in October 2017. I remember the storm came in and we had to shut the site down. But we delivered it in exactly 2 years, a complex apartment project within 2 years. We ran into no hiccups and we transacted at the back end of the year. So, look, we realise if we want to be a deliverer, if we want to be the scale player in the market, we do need this skill set. And we've invested in that and we hope to roll that out. And the other thing too is, and we've seen it with other people, and you hear a lot of talk about the Children's Hospital in Dublin and how that's gone really wrong. Exposure to contractors can bring a lot of risk. They can bring certainty in the sense of delivery, but they can bring a lot of risk in not being able to control the costs. And I suppose controlling those costs in-house and being able to deliver is very important for us. And I think we have the team and the capability. And it's not only just where we're delivering it to today and, the guys will deliver it through their methodology, but where we want to bring it to in the future. Again, we're talking about this off-site construction, and that's where the huge opportunity is in that delivery. And I suppose the key for that is having the machine to deliver it, but having the demand at the other end of it as well. And if you can marry both together, that's where you can really maximise that opportunity.
Hello. Yeah, perfect. Just on partnerships, when partnerships comes into the mix, I think you were keen to point out at the start that although it's not in the unit guidance, that when partnerships come in, that will be substituting other deliveries in terms of keeping that 3,000 target. Was that right, just in terms of my understanding?
That's right.
And given that, when we do see partnerships, obviously fantastic return on capital employed, great certainty, it does typically come at a lower margin. So just in terms of baking into my guidance, if there was to be 500 units in partnership delivered in 2024 or somewhere far out in the DCF, I should model that as a lower margin. So just thinking about my margin over time, when partnerships come in, there will be margin compression from that, given they're not incremental units.
Yeah, and I think that the challenge there is going to be, and it's, you know, that's the exact conversation that we've had internally ourselves, is, you know, you're replacing a lower margin with, you're effectively taking 500 units out of a higher margin and putting it into 500 units into a lower margin business. You know, putting the return on capital to one side for a moment, because, you know, obviously it's significantly better. I think the challenge for us is it's not as simple as take 500 out and replace it with 500. You know, we're conscious that it may be we put an extra 100 units into that if partnerships suddenly come in, but it's certainly not take 500 in partnerships and add it onto the 3,000 and you suddenly get 3,500. It's not that. But I think if partnerships comes in at that lower pure euro value in terms of profit, we'll have to look at that capability. But I think certainly the benefits of partnerships certainly are very attractive, and you know, hence the reason we're willing to put them into the overall delivery.
Thank you.
Okay, I see, just in the interest of everybody's time, we said we'd sort of finish up a quarter. I see 2 or 3 more questions. There's Dermot is there, and then we owe an answer on the election question as well, which we haven't forgotten about.
Yeah, hi guys, Dermot O'Leary from Goodbody. Just 2 quick questions. One on land prices. I mean, you talk about stabilisation in land prices, but I suppose there's probably kind of 2 speeds going on between suburban, which has probably fallen quite significantly, and then urban, which has other dynamics going on. Do you see that on the ground, and will that kind of dynamic change your view as to where the value is in terms of where you buy land over, say, the next 12, 18, 24 months? Maybe just on the apartment side then, again, kind of a 2-speed thing going on between the cost of apartment building and cost of house building. You know, what kind of dynamics do you see going on there? Is it double the price in terms of cost inflation in apartment building relative to house building at the moment?
Yeah, certainly certain elements of the apartment construction would move faster. I suppose that I was making the point to one of the shareholders earlier on is that when you are actually doing one of these large urban projects, you're probably locking in around 60% of your procurement before you start the project. So you're nailing down the likes of your curtain wall, windows, finishes, etc., etc. So you're doing a lot of buying up front. So you do have that locked down much earlier, because you are conscious of it's quite a large project and you want to control it. And obviously we're baking in whatever CPI it will be required. It has moved in different parts of the apartment element has moved faster than others. And it's obviously points in time as well. If you think about apartment construction, it's obviously quite intense. The likes of curtain wall, if it clashes with other big infrastructure projects, the likes of the hospital, which is ongoing at the moment, obviously that can make constraints on the market. But a point that Fergus has made to us, and something that we looked at, is, you know, obviously the London market has cooled down. There's certain capacity here. But there's Irish people who are working in London and doing contract work who want to get back to Dublin. And I suppose we're offering them that route. And they've learned, like it's a specialised skill set they're just used to here for years. And obviously, if we can bring that into the system, we'd hope to control our costs moving forward. On the land side, and Wesley, happy for you to jump in. There's been urban, obviously, sites have moved because of obviously the demand for PRS, but good quality suburban sites, the market has been pretty stable. If there has been falls in the land market, where it has predominantly fell is land that is long infrastructure. It doesn't have water, doesn't have sewerage, has constraints with roads, rail, etc., things like that. And I think one thing that we really focused on when we were deploying our capital, and I think it's testament to the businesses, we've opened 20 sites. You know, if we bought sites where there was constraints, we'd be still looking at them. Obviously, we're trying to open them on an ongoing basis. But I think there's been that element of the land market that has come back, because, you know, think about it. If you're buying land and you're putting your money in for 5 or 6 years and you won't see a return, is that a really good investment? So I think that has cooled down to a certain degree. But the good product, the good sites with where that proper housing is and where the demand is pretty stable for the last 12 months. An example of this, I'll give you live. Sorry, I'm not going to cross it. We bought Leixlip last year, right? And we negotiated with that landowner 12 months previous to that, and we didn't get to a deal. We came back and revisited, and it was exactly at the same price it was 12 months previous. But it's the same quality site, and we've just opened it. It's a fantastic site.
And I think that's the key point. Like there's an expectation from vendors in terms of where pricing may be at. And what we're seeing is, we would view it as there's a blend pay price that we will pay for the asset. And if we can acquire it for that asset, we will acquire it. If not, we'll wait. And I think what we are seeing is in cases that those assets are coming back around. It takes a little bit of time, but we are getting them. And I think that's the example. I think just on the urban point, I think ultimately what you're seeing there is, rent and yield is what's going straight to value. People are just, doing their maths and putting it straight onto land. Back to what we've said around counterparty and covenant, I believe what you're going to see is some of those assets come back around because people can't exit, and I think that's where the opportunity for us will be. Yeah, there'll be competition for certain assets, but I think there's such a volume in that market that opportunity will present itself.
Okay, maybe to finish on the election question from that gentleman.
Yeah, if you look at the Paddy Power, looks like Fianna Fáil are going to get in pretty much, and they're either going to be with the Greens or with Sinn Féin, by the looks of things. And I'm just wondering, based on your kind of guidance for the next 3 years, how those would change under those two different scenarios.
Well, first of all, we should never comment on politics, but I suppose what we would reiterate is that our plan is set on the dynamics that exist today. Obviously, there's been a lot of promises from political parties on the likes of Help to Buy and driving more housing, which, we have to see how that plays out. I think both main parties have made a commitment to increase Help to Buy. But look, obviously, we're just living with what the facts that are on the ground today. It has to be taken into context of the macro-prudential rules are, to a certain degree, the control element on the overall market, and they will be the biggest constraint no matter what. Not really a constraint, it's a bit like it's just controlling the market overall. But I think it'll be interesting to see what comes out of it. If it's a Green Fianna Fáil thing, yes, there'll be a lot of housing initiatives, and there'll obviously be a lot of what Peter said we have gone to NZEB already. There'll be a further drive to that, which will be, for us, we'll be well able to deal with that.
I think if you were to rewind back 12 months, the best case scenario you were going to come out with last year was the status quo, because we knew the macro-prudential rules were up for renewal, and the question was, would they be renewed or not? I think now, looking at the political environment and the commentary, probably the worst case scenario you're going to come out with is the status quo. So we've outlined our plan based on what we see in the market today. Yes, there's talk of upside to that, but we're very comfortable with where things are at as well. Okay. Stephen just had a few.
Yeah, I suppose. I wrote down my closing remarks.
Public address.
Public address. Yeah, I suppose just a couple of key things and things I want people to take away. It was interesting. We all arrived last night and we checked into the hotel, and one of the large UK developers were having a conference for their salespeople. So I decided to sneak in and have a view. But something I found very interesting was there's a lot of similarities between us. And I suppose if I was to say it into context is that we are the Barrett or the Persimmon of the Irish market in relative terms, and we have all that opportunity in front of us. The opportunity is compelling. It hasn't changed. If anything, I'd be more confident about that opportunity today. Obviously, due to various things, the macro-prudential rules are having their effect. We live in the most conservative housing market in the world, I believe. And I sometimes describe it, it's a bit like we're driving down the road and the handbrake is slightly pulled up. And that's the way as I would describe our housing market to a certain degree. The competition doesn't exist. It's been identified. We're delivering 21,000 homes a year. Go back to my concrete analogy, I don't see the supply coming into the system. The foundations aren't being dug out. Which means the smaller players are really struggling. And the only one who is actually delivering any volume into the market is ourselves and the likes of Cairn. We have bought the right land to deliver the right product. And that is key. It is really working. We delivered 844 units last year because the demand was there for the right product, and we have that right product delivered. We're scaling it now to capture the opportunity. That's the key. You know, we do see the opportunity in front of us for all the things I've outlined, and we really do want to capture that. And I suppose a couple of things. We're capturing it through the ways we're doing business. And, you know, the guys talked about, you know, the technology, the methodology, all of those things. They have never been seen in our market before. And it's not been revolutionary or anything like that. It's just using best practice. And an industry that for 30 years has stood on its hands and done nothing in productivity, hasn't embraced technology, hasn't embraced a new way of doing it. This is a huge opportunity. But you need to be a scale player to be able to do that. And I suppose that's a couple of key things. Michael talked about the capital profile of the business, how that's going to evolve over the next number of years. And that is key. And a point we really make to a lot of investors is we realise we have a big balance sheet and we need to grow the revenue. That is our main ambition, is to drive that revenue as fast as possible, whatever way we have to do it. And then you have a proper working machine. That's where we want to go. We really want to capture the market opportunity that's in front of us. And that will change the dynamics of this business. And I suppose a couple of, you know, you've seen the team today. And I think a big thing we want to roll out today was the team. Put the team in front of you, see what they're like. And this is some of the team, but there's a lot of other people behind us. And it is quite a phenomenal machine that has been built over the last number of years. We've been on this journey for 10 years. We've now outlined where we want to go for the next 5, but we've 10 years ambition in front of us, what we can do here. So I'd like to thank everyone that helped put this together today. I'd like to thank all of you for coming today. I'd thank you for all your support. And look, I suppose I describe it. We've travelled the journey so far. We've a long way to go, but we will reap the benefits of this if we get there. So thank you. I think Conor wants to say something about.
Just finally, feedback is always appreciated. So you get you've already got an email from me asking for, so we'd really appreciate it. Thank you. Cheers.